investment banking, which is different from commercial banking. And today we have a guest, Jan Fugner, who took this course almost 10 years ago and has been working in investment banking since. I'll introduce him in a few minutes. But I wanted to start with just the elements of investment banking, and then I want to talk about changes in it that came about after the financial crisis of 2007 through 9. So, okay, the topic is investment banking, and that is a term, a 20th century term, that first became big and important, I would say, in the 1930s, but preceded that by some years. And it refers to a business of helping other businesses create securities. If someone wants to issue stock, they go to an investment banker to help them. Or if you want to issue bonds, you go to an investment banker. It can be a corporation that goes to the for-profit. It can be a non-profit corporation. It can be a government. I suppose even an individual who is incorporated can go to an investment bank. That's the investment banking business. Now, it differs, it shares something with the consulting business, because investment bankers serve often as consultants. A company will come to an investment banker with a problem, and they want to raise money by issuing new shares, for example, to solve that problem. But if it's a good investment bank, they will do more than just issue shares for them. They'll talk about their whole corporate strategy. So in that sense, an investment bank looks like a consulting firm. But that's not, because they don't do pure consulting. They're not. That makes a distinction. Maybe they're in many ways a favored consultant because they bring money, right? You can talk to a consultant who will bring you no money, and another consultant who has his hands on money somewhere, and that helps a lot. You know, the advice and the money together helps a lot. So investment bankers are different from traders because they usually they deal with creating something, about making a corporation or a government, making it work, and enabling them to do something that they want to do, and then being realistic about it and coming up with the money to do it. And so that's how investment banking differs from consulting. And it differs from commercial banking in that a pure investment bank does not accept deposits. You can't go to your investment bank and say, I'd like to open a savings account. They don't do it. Okay. I'm talking about a pure investment bank. Let me just give you something about this business. I'm going to come in a moment to pointing out that most investment banking businesses are not pure investment banks. But let's talk about what a pure investment bank does. It does underwriting of securities. That means, suppose you're a company and you want to issue shares. You need someone to go to bat for you, someone who knows the kind of people who might buy your shares and can vouch for you. So in some sense, it's a reputation thing. The investment bank has contacts among people who make big investments, and they manage the issuance of your new shares, and that's called an underwriting. If it's the first time you've issued shares, it's called an IPO, or initial public offering. So you're a private company. It's just you and a few friends own the company, but now you want to go public. You would generally go to an investment bank and talk to them about how to do it, and the investment bank would solve that problem for you by doing an underwriting. So traditionally, there's two kinds of underwriting. There's also something called a seasoned offering. And that means for a company that has already gone public and it already has shares traded so that the shares are seasoned, but you want to issue more shares, so you can go to an investment bank to do that as well. Okay. There's two kinds of deals. There's a bought deal, and then there's a best efforts. With a bought deal, the investment bank buys your shares. They go in and say, you know, we know that we can get market for your shares. We will buy them ourselves and resell them on the market. A best efforts offering is one where the investment bank doesn't buy it and doesn't promise anything. They say, we'll make our best efforts to place this offering. Okay? So those are the basic things that they do. The methods that they use are regulated by the Securities and Exchange Commission in order to make the SEC in the United States and regulated similarly in other countries. So that's the basic investment banking business. So if you're thinking of where to place yourself, I think investment banking suits very well people who are, it's not good for autistic people. If you're autistic, be a trader, okay? Then you just get on the phone and you buy and sell all day. And you can be rude, and you can have coffee stains on your shirt, and you don't have to know anything about classical music, okay? But investment bankers are a different. I see Jan is laughing. Tell me what you know about classical music. I assume that was part of your training at Goldman. He says no. It's a whole different industry. So yeah, if you go to the symphony and look around, you'll see lots of investment bankers there, but you won't see any traders. You nod on that, maybe. So we talk about moral hazard. I think that an important part of what investment banks do is solve a moral hazard problem, and that problem is that companies who issue shares don't have a reputation. And so what do I care? I'll issue shares right before we're going to go bankrupt, okay? We know inside that we're going to go bankrupt. So hey, let's just see if we can milk this company before the public knows it, okay? And issue shares. That's a moral hazard. And the investment bank is in business to prevent that moral hazard. They do the due diligence. They check you out. And then after that, people are more trusting of the... So I think investment banking is built around trust. It's establishing trust. And so that's how it differs from a lot of other... That's why it's important that these people be cultivated and impressive people. They tend to be well-spoken. I can ask Jan whether he agrees on all this, but it's my impression. You can tell when the investment bankers walk in the room. They dress differently. They look differently. I don't know what it is. It's something about reputation is what it's built around. Okay. The investment banking industry. I'm trying to see how to present this. Let me just, since I'm talking about the nature of investment banking, and since we have a Goldman Sachs representative here, I put on your reading list a book as an optional reading by Charles Ellis called The Partnership, and it's a history of the partnership, and it's a history of Goldman Sachs. Goldman Sachs was an investment bank until just very recently, and we'll talk about that. They're still in the investment banking business, but now they're officially a commercial bank. It's an old, venerable firm, and Goldman Sachs emerged in the early 21st century as, I think, the most highly respected and esteemed investment bank in the world. Amazingly successful and amazingly well-respected. Ellis wrote a book just a few years ago. Ellis is on the Yale Corporation. He's a distinguished businessman and author himself. And he wrote a book about Goldman Sachs, which is largely admiring. Like, how did this happen? How did this phenomenon of Goldman Sachs come about? And I suggested you read one chapter. It was called Principles. And it says something about Goldman Sachs. And it refers to, in that chapter, the chairman of Goldman Sachs, John Whitehead, in the 1970s, wrote down a list of principles that guide Goldman Sachs. And Ellis seems admiring of these principles. Not everyone would agree. It's a matter of taste, I guess, in living. But Whitehead is not, I just looked it up, he's 88 years old and is retired from Goldman. Must have retired some years ago. So what kind of an organization? Ellis says that the thing that struck him about the organization is loyalty. But that's not that people feel a strong loyalty toward their company. That's not on Whitehead's list. So Whitehead's list, what is his first principle of Goldman Sachs? Our clients' interests always come first. All right. These sound a little bit like bromides. I'm sorry, but I read them thinking, it is the most successful investment bank in the world. So maybe there's something beyond. I think there is something beyond platitudes here. Second, our assets are people, capital, and reputation. Okay, that's coincident with what I said. Uncompromising determination to achieve excellence. Well, everybody says that, so maybe we'll discount that. I mean, we stress creativity and imagination. Well, those are sort of bromides, maybe. But I thought then Whitehead issued some guidelines. This is also in that chapter later for Goldman Sachs employees, and these seem to be a little bit more candid. The boss usually decides, not the assistant treasurer. Do you know the boss? Okay, that's sort of something that I've learned about from my own interaction with people. The boss really does decide, and Goldman Sachs goes for the top. And maybe this is obnoxious. I don't know. They don't want to talk with underlings. You never learn anything when you're talking. Okay, it means be a good listener. The respect of one person is worth more than the acquaintance with 100. There's nothing worse than an unhappy client. But one thing that, I don't know if it's on Whitehead's list, but I think it really says something about investment banking, and that Ellis says, is that they shun publicity. They don't want to be in the newspaper. They want to be known by the president. They want to be known by a few prominent people. They're kind of social climbers in a way. But it's all built around some basic principles of service, and they want to be talking to the top guy, and they don't want to be in the newspaper. I was going to quote Ellis on this. Now I'm quoting Charlie Ellis. I call him Charlie. I'm sorry, I know him. He's a friend of mine. Making money, always and no exceptions, was a principle of Goldman Sachs. Nothing was ever done for prestige. In fact, the most prestigious clients were often charged the most. Absolute loyalty to the firm and to the partnership was expected. The real culture of personal anonymity was almost a core value. The real culture of Goldman Sachs was a unique blend of drive for making money and the characteristics of family in ways that the Chinese, Arabs, and old Europeans would well understand. So I'm giving you a flavor of what an investment bank is. You might be repelled by it. You know, is making money so important? And if you are repelled by it, you probably don't want to work for Goldman Sachs. On the other hand, they're kind of respecting some economic principles, right? Working for a firm like this, you can make huge amounts of money, and then at the end, you can give it all away to charity. And you know, that's the new capitalism, right? So what's wrong with that? What are you going to do with all this? If you make $100 million, what are you going to do with it? You're going to give it away, right? And maybe, I mentioned at the beginning, I mentioned Andrew Carnegie's book, The Gospel of Wealth. Maybe that's what this is all about. On the other hand, some of them don't give it away, and some of them live lavishly. So I don't know, different people have different impressions of this business. But I want to make sure I have time for our guest, and I'm sort of running out. I wanted to talk about what has happened in the crisis. There's so much to say about this topic, but maybe I should talk first about the first crisis. In 1933, the U.S. Congress passed the Glass-Steagall Act, which forced investment banks and which prevented investment banks from doing commercial banking or commercial banks from doing investment banking. It split them in two, and it said, you have to decide, are you a commercial bank or are you an investment bank? The Glass-Steagall Act was the act that created the FDIC, the Federal Deposit Insurance Corporation, the first national, successful national deposit insurance act in the world. And part of it makes sense. If you're going to insure the commercial banks, you better watch what they're doing and prevent them from doing dangerous business. So the dangerous business was investment banking, and they forced companies to decide. So J.P. Morgan, which was doing both investment banking and commercial banking in 1933, had to decide, what is it, investment banking or commercial banking? So they picked commercial banking, and that means they fired all of their investment bankers. So these guys regrouped, and they formed an investment bank called Morgan Stanley. Stanley was a Yale graduate, and Morgan was, I think, not J.P. Morgan, it was his grandson. This was, you know, Morgan died around 1911. And so those were two separate, one, J.P. Morgan, commercial bank, Morgan Stanley, investment bank. But since then, we've repealed the Glass-Steagall Act, and that occurred with the Graham-Leach Act of, what was that, 1999? Well, Graham-Leach repealed Glass-Steagall, and now these businesses generally do, they generally do the same business, both commercial and, yeah, that was Graham-Leach was 1999. Okay. Since then, you might, as you recall, we've had a financial crisis. And in that financial crisis, Glass-Steagall got brought up again because it seemed that the crisis was related to a number of shenanigans that firms were undertaking. And the government had to bail out commercial banks. We've talked about this, and it's very controversial. So the question is, did these banks get in trouble because we repealed Glass-Steagall? A lot of people came on saying that. These banks were doing all kinds of screwy things that were dangerous, and we were insuring them, so it can't be. So a lot of people said we have to go back. There was some inherent wisdom in Glass-Steagall that we've lost, and this was debated. Now, incidentally, I didn't mention this. Glass-Steagall was somehow confined to the United States. Outside of the United States, there was, I don't know if there was any country, but as far as I know, the U.S. was the only one that did it. So outside of the United States, they had what was called universal banking. And these banks outside of the U.S. were doing both investment banking and commercial banking. They sailed right through the whole century without being divided up. And so the reason why we got Graham-Leach was that we started to, people started to say, we're at a competitive disadvantage. We Americans are at a competitive disadvantage to Europe because we can't do both, and they have more freedom than we. And so eventually, in 1999, we said they could do both. So the U.S. also became a universal banking country. But then problems arose, and the problems were Paul Volcker, who was chairman of the Federal Reserve Board in the late 70s, early 80s, proposed something called the Volcker Rule. And the Volcker Rule was not a full return to it was not a full return to investment to Glass-Steagall, but it would, and this is now in Dodd-Frank Act. It's section 619. It doesn't say Volcker Rule there, but that's what it is, and it prohibits proprietary trading at commercial banks. And it also says that commercial banks can't own hedge funds or private equity. So that was the Volcker Rule that was put in. There was also another rule added, which is analogous to the Dodd-Frank Act. Also, and this is in the Dodd-Frank Act of 2010. There was a senator. Her name was Blanche Lincoln, a Democrat from Arkansas, who proposed the Lincoln Rule, unrelated to Abraham Lincoln, as far as I know. And the Lincoln Rule was a Lincoln Amendment, and that is section 716 of Dodd-Frank. It says that it doesn't prohibit banks dealing in credit in swaps, but it said swap dealers barred access to the Fed window, discount window. And so effectively, it prevents banks from dealing in swaps anymore. As a result of this, Goldman Sachs has got to shut down, or it appears that Goldman Sachs, the Volcker Rule says banks have until October 2011 to comply. So it means that Goldman Sachs has to shut down. Well, Goldman Sachs had to become a commercial bank too. So it's no longer a pure, it's a official commercial bank now. And because of the Volcker Rule, it appears that it has to shut down its proprietary trading, which was a huge part of its profits. And Goldman Sachs will never be the same again, apparently. But it's not clear what will happen. It depends all on how Dodd-Frank is enforced. I think that people in the investment banking industry are going to try to claim that some of the activity that was done by their proprietary traders, that is, people who were trading the markets on the I understand true investment banking shouldn't involve the investment banker buying and selling securities trying to make a profit. That's not underwriting of securities, that's proprietary trading. The Volcker Rule says that you pretty much can't do it anymore unless you were a pure investment bank. But if you're a commercial bank, you can't do it anymore, and they're kind of forced to become a commercial bank. But they're going to try to steer around these rules, and they think that maybe they can. They'll redefine something that looks something like proprietary trading, and then continue to do what they're doing. We'll have to see. These things are long and arduous. One thing that strikes me about finance is that it's so rules-based. There are so many laws. There are so many lawyers that you can never, nobody can grasp the magnitude of the regulations that these people live under. And you see these landmark bills, but none of us understand them because the real content of them is involved in hundreds of pages of legal documents that never cease to amaze me with their complexity. Let me say something about shadow banking, which is relevant here. The term shadow banking, I think of that as coming from a term that I first heard from people at PIMCO just within the last 5 years or so, but it refers to, maybe it goes back further than that, it refers to a new kind of semi-banking system that what are shadow banks? These are companies that are acting like commercial banks, but they're technically not, so they're not regulated as commercial banks. And in many cases, the investment banks were shadow banks. And I'll give you an example of Lehman Brothers, which was a pure investment bank. It's now bankrupt, it's gone. It was a pure investment bank, so it wasn't regulated as a commercial bank. And this was before before the Volcker rule, before Dodd-Frank, and they went bankrupt in 2008, and it was the worst moment in the financial crisis. Why did they go bankrupt? Well, there's a reading I have on your reading list by Professor Gary Gorton here at Yale, who argues that Lehman, like many other investment banks, was financing a lot of proprietary investments by issuing repos, or by dealing in repos. What is a repo? That's short for repurchase agreement. The banking crisis that we saw in 2008 was substantially a run on the repo. So here's what happened, according to Gorton and others who agree with him. Investment banks like Lehman Brothers were not regulated like commercial banks. And as long as they didn't accept deposits, they didn't have to be regulated as commercial banks. So they could do what they wanted. They were considered underwriters, so fine, do whatever you want. Well, not quite, but they weren't heavily regulated the way commercial banks were. And what Lehman Brothers started to do is to make heavy investments in subprime securities and other securities by effectively borrowing through the repo market. And what is the repo market? It's a market in which a company effectively borrows money by effectively selling some securities it owns with an agreement to repurchase the security at a later date. They're short-term loans, in fact, collateralized by some security that they own. What it was is almost the same as a deposit. They were short-term loans that someone could withdraw at any time. The someone wouldn't be some, mother and father with their small savings account. It would be some bigger, probably institutional investor. But these were acting like banks, like commercial banks, because there could be a run on these banks the same way there's a run on a commercial bank. If anyone starts fearing that Lehman Brothers is going to fail, they all want to take their money out, which means they don't renew their repos. And so Lehman Brothers failed when the housing market declined, the value of its subprime securities declined. People who were lending its money through repos got wind of this, and they stopped wanting to do it. So it was like a run on Lehman Brothers, and Lehman Brothers could not be saved if it weren't for a bailout. And the government had already bailed out Bear Stearns, and it had helped Merrill Lynch, which was failing as well. And they decided not to bail everybody out, so they let Lehman Brothers fail. So now, the reaction to that is that we can't let shadow banking go unregulated, and Dodd-Frank is part of that reaction. So now investment banking is substantially altered by these laws, and still, of course, it's a very important business. The United States has traditionally been the most important country in investment banking, but it continues that Europe and Asia are also important, very important participants in investment banking. Growing, I think. The financial crisis has put something of a damper on the business for a while, but I think it seems to be coming back. The latest news is that investment banking business is starting to look more stable and prosperous. So I think what I want to do now is invite, let me just do a brief introduction. So Jan Fugner took this class, I think it was 2002, and then he served as my research assistant for a book I was writing called New Financial Order, so I got to know him better. Well, I guess the important thing for this lecture is that you worked for Goldman Sachs and got to know people there. And now is working for Facebook, which is, you've heard of this company, right? And I thought it'd be interesting to have him back to give his impressions of what life was like after Econ 252, of what Goldman Sachs was like, at least the old Goldman Sachs. And I think, it's interesting to hear about Facebook, too, because it's a different kind of culture, and I'm interested in culture. It's more of a tech business. I'm interested to hear if they have anything like the Goldman Sachs principles, where they enunciate them the same way. So I'll bring Jan up, and I'll let him continue.
Great. Well, thank you, Professor Schiller. And Professor Schiller has promised that I'll be well-spoken and well-dressed and a bunch of other things, good, bad, or otherwise. Not sure if I'll live up to any of those expectations, but hopefully can share a little bit about this business. So how many of you are considering going into investment banking? Maybe about 30% or so. Okay. And how many of you are on Facebook? Okay. And how many of you are considering working at Facebook? Okay, so maybe we'll add a few more to that by the end of this. Goal for the next half hour is really to help you think about whether banking might be the right next step for you after college. And for those of you who say yes, to share a few tips on how to think about getting into the business. So I'll give a little bit of my background, kind of as context for my reflections on the industry, so you can take them with a grain of salt. Share some anecdotes from banking during the debt boom, and then also give a few tips for steps that you can take today if you're interested in it. A little on my background. Junior summer, I went and worked at a large investment bank, as Professor Schiller mentioned, and I really enjoyed the work, knew that I wanted to go back to it, but I had never lived abroad because, as you all know, your junior year here at Yale, there's a lot going on with extracurriculars, and so many people don't go abroad. I went to see Charles Hill. Now, how many folks are familiar with Charles Hill? Fabulous negotiator, and I said, Professor Hill, how can I negotiate to go back to this job a year later so I can do a Fulbright in the meantime? So he taught me all this jiu-jitsu, and it ended up working out, and I did a year in Norway, and then came back full-time to banking. Now, as you probably know, a lot of analysts go into banking, they do it for 2 years, maybe do private equity, hedge fund, maybe do an MBA afterwards, and something like 15% might stay on, get promoted, and become career track bankers. When I was working on Wall Street, this was the peak of the most recent private equity boom and the associated debt boom. And so recruiting to private equity had reached such a fever pitch that literally 16 months before the start date for these jobs, analysts were getting calls from recruiters, doing interviews, and actually making commitments to join these companies. And I knew I was interested in tech, and so I became very close to signing with a technology private equity fund that I admire still very much to this day, but I actually decided that I wanted to work in tech itself. And so the last 3.5 years, as you mentioned, I've been working at Facebook, working on our social advertising strategy. So a little bit about inside the banking role. It may sound a little bit funny to talk about the investment banking division of an investment bank, but that's what we'll do for the next 15 minutes. And by that, I really mean just the part of the business that Professor Schiller mentioned, giving advice to CEOs and CFOs about financing and mergers and acquisitions. So if you see this logo, and that makes you smile, I see a few smiles, maybe a couple grimaces. If it makes you smile, that's a good sign that banking may be for you. You think about 2, 3,
We don't
4.
understand that. That's an Excel logo.
That's an Excel logo.
What are you driving?
That's an Excel logo, and these are Excel models, and they go on and on.
You mean you're going to be a nerd? Is that what you're saying?
Yeah, if by that you mean you want to feel comfortable with the technical aspect of the role, yeah, absolutely. So especially at the junior level where you mentioned some of the relationship aspects of banking, but at the junior level, really your core responsibility is building out these models. So if you think about working on that till 4 in the morning, maybe 2 nights in a row, maybe 20 nights in a row, and that's exciting to you, that's a good sign. So how many of you have gone online to Open Yale to see Stephen Schwartzman's talk from this class 3 years ago? 1, 2 enterprising users of the internet. Would strongly encourage everyone to do that. One of the things that he talks about is that in banking, there's not a ton of flexibility for getting the numbers wrong. As the analyst, you really need to nail the details, and primarily what we're talking about there is building operating, transaction, and valuation models that describe your clients and other companies in their industry. And then the information from those models, along with research you find by hook and by crook on the internet from your colleagues, wherever you can, kind of comes together into presentations, polished pitch books to help win a piece of business. So that could be an IPO, a merger advisory, as you mentioned. And once you've won that piece of business, then you as the analyst really are the organizing principle for getting this deal across the finish line, dealing with the accountants, working with the lawyers, other bankers, even competitors who might also be working on the deal, and then, of course, your client and whichever counterparty your client is selling to or buying from. So it's a fair amount of responsibility. Typical investment banking deal team, the core team is pretty lean, maybe 1 each of an analyst, associate, VP, and MD. And if you decide to and are given the opportunity to continue working in investment banking on a career basis, then you will gain a little bit more control over your week-to-week and month-to-month schedule as you become more senior. But even at a senior level, investment banking is really considered an always-on-call client service profession. Now, one of the advantages of this very lean deal team is that there's plenty of responsibility to go around. So if you raise your hand and say, yeah, I can take on some of this work that might by default fall to my associate, and you do it without making mistakes, you're going to be able to get more and more responsibility, learn more and more on the job. So one of my favorite projects that I worked on was a proposed venture capital transaction where we were looking at investing in 8 different operating companies. And because the team was that lean, I was actually able to basically take on leading the due diligence on these 8 different companies.
Before you go ahead, well, why do the managing directors have 0 gray hairs?
Well, I'm just assuming it's all gone by now.
Okay.
Yeah. That's a median. The mean might be a little bit higher. There's high variance. So I would... Was that the nerdy comment you're looking for? So I might encourage you to think about these roles as an investment in your career, where what you put in, of course, is long hours, maybe 100 hours a week for a couple years, and what you get out is a number of things, including a skill set that's really valued and respected, not just in finance, but around the business world, exposures to CFOs and how they think about problems. If you decide to continue on as a career banker, participation in the success that you help create for your company, and then, of course, a network of very smart, eager peers, like the folks in this room, who then fan out across the finance industry. So as I mentioned, I was banking during the debt boom, and there was such a peak in transactions that people started calling it merger Mondays, this expectation that before the bell at the beginning of the week, there'd be a $20 billion or $30 billion, $40 billion transaction that'd be announced. And there was so much enthusiasm for this sort of transaction that even financial institutions, which conventional wisdom told us couldn't be LBO'd because their balance sheets were already so levered, actually became considered targets for leveraged buyouts. And arguably the peak of this was when Blackstone themselves, one of the fathers of the buyout industry, filed an S1 and in fact became a publicly traded company, which they are to this day. Your final task as a banking analyst is to create a deal toy when you successfully created a transaction. Now, this particular one used to have water in it and glittering fish, and at the time I thought it was very pretty, but I would just invite you maybe when you create your deal toys, don't picture your client swimming with the fishes. Not the best idea. And then this is a safe for a bank, which of course is logical. Safes are in a bank. But this is actually an especially fun toy because you pull this handle here, and then actually this one opens up. Well, that was my idea of fun when I was a banker, so again, take it with a grain of salt. This is a snow globe. You shake it upside down, which is a lot of fun as well. But again, just in terms of the metaphor, and I have only myself to blame, maybe I was sleep deprived, I guess maybe don't show your client's capital structure literally underwater when you design your deal toys.
Are you saying our investment bankers have a childish side? You say deal toys. I was presenting them as going to the symphony. What are you presenting them as?
I can't claim I ever made it to the symphony when I was an analyst, but a number of my colleagues were on the boards involved philanthropically with those organizations. But yeah, I think that we have this creative energy and creative spirit, and I think there's a lot of creativity in finance, as Steven Schwartzman mentioned in his talk, at the senior levels when you're dreaming how to combine companies, how to finance companies, how to deal with new regulation, as you mentioned. But at the analyst level, maybe not quite as much. So maybe there is that creative spark that's just trying to find its way out, one mischievous way or another. But anyway, this was a landscape when I left banking. That was September 2007. And then 6 months after that, as Professor Schiller mentioned, Bear Stearns sold in a fire sale to JP Morgan. And then 6 months after that, September 2008, we saw Merrill Lynch narrowly avert liquidation, become the asset management brand of Bank of America, which it still is today. That same week, Lehman Brothers collapsed under the weight of those mortgages, suffered a bank run, and was not bailed out, was liquidated. Some of their investment banking capital markets assets sold to Barclays in bankruptcy. A week after that, what a lot of people thought would never happen did happen. And Goldman Sachs and Morgan Stanley went to the Federal Reserve, asked to become commercial banks, which technically they still are today, as Professor Schiller mentioned. Now, that having been said, if you take Charles Gasparino's account of this era, this was the end of an era for Wall Street. That having been said, investment banking continued at firms all around the world, some of these diversified conglomerates, and also at a burgeoning slate of so-called independent advisory shops. So these are folks like Evercore, Lazard, Greenhill. And if you're interested in learning about finance, investment banking is not the only way to get into it. There are also, for example, the so-called alternative asset managers, private equity and hedge funds, folks like KKR, Carlyle, Bridgewater, who I believe still recruits here on campus. And then out where I live in California, you have the heart of the venture capital industry, especially around the information technology industry. So folks like Kleiner, Sequoia, Benchmark. Now, they may not be recruiting on campus, and they may not even be open to hiring undergraduates, but some of their competitors are. So if that's interesting to you, maybe we'll just touch on a few steps that you can take today. Obviously, you're already doing plenty of this without anyone having to remind you, things like taking the right classes, doing well in them, researching the firms you want to apply to. Just 3 that I'll touch on. Taking advantage of the incredible resource you have in the professors here today, which you really don't want to take for granted. Learning a little bit about yourself, and I know that sounds touchy-feely, but I'll give a couple of specifics around that. And then, of course, there's no substitute for trying this hands-on to see whether it suits you. So this is pretty much exactly as I remember John Giannakopoulos, genius, mad scientist. You can find him on Open Yale now. And if you have not yet taken his class and it's offered next year, I would strongly recommend that you do so. David Swenson, I understand you've had the distinct pleasure of hearing from already, the most successful endowment manager ever, the reason that we get to have nice things here at Yale. And I just keep coming back time and again to pioneering portfolio management, the bedrock of core investing principles that he articulates in that book. Even if you never become an institutional investor and are only thinking as a retail investor, still incredibly useful stuff. And he does teach a senior seminar. And then in addition to this class, as you probably know, Professor Schiller has a graduate seminar, which I think you have promised to let students apply to get into.
Yeah, I had about 8 last semester.
Okay. And how'd they do?
That's an embarrassing thing. They did pretty well against our graduate students.
Yeah.
I won't rank them. Embarrassing to our graduate students.
But flattering to all of you. As Professor Schiller mentioned, I got to work a little bit on New Financial Order as an undergraduate, and I just still consider such a rewarding experience because the tenets that you talk about in this book around how finance can be a technology for societal innovation, everything from the micro level of personal income insurance to encourage people to take more risks early on in their careers, to the macro level of GDP insurance, are some really visionary ideas. I, of course, remain dismayed that some of them have not been put into practice yet, but that really is an opportunity for all of you who are interested in finance for idealists to think about that as a potential career option for you. Other useful courses, of course, anything with math, probability, stats, econometrics, Excel modeling, especially using the 3 financial statements, computer science, computer programming is going to serve you well, not just in investment banking, which we're talking about this morning, but also in those other aspects of financial services like trading. Now, kind of switching gears a little bit, how many of you have either done Myers-Briggs or StrengthsFinder? A few, maybe 20, maybe 30% or so. So these are tools that I think have become a little bit more popular in recent years, which are basically psychological inventories, where you spend an hour answering multiple choice questions, and then they literally spit out a profile of how you like to work. So obviously there's no right or wrong answers. They're really just preferences. It's a pretty modest investment of your time, maybe an hour each, to gain insight, not just into what you're good at, but also into helping you articulate to potential employers really what you can bring to the table. And then, of course, where the rubber meets the road is actually applying for that internship or that job and getting your foot in the door. Career services on campus are a fabulous resource, but because of that, they're a very scarce resource because almost everyone's using them. So if you want to find jobs that don't get 200 other Yale resumes coming in their front door, you want to look a little further afield. So you've got things like lists of investment management firms from Institutional Investor, American Banker, Hedge Fund Research. There are plenty of these lists. And I'd say don't be shy about cold calling, cold emailing. Just kind of be persistent. We touched on professors here. I am incredibly grateful to Professor Schiller, Ray Fair, David Swenson, folks who have helped me in my career, even at this extremely early stage of my career. And it was really just because I asked. And I'd encourage you to do the same thing because once you've left campus, it gets a lot harder to get that help. And then the alumni directory. How many folks have been using the alumni directory to reach out for jobs? Maybe 15%. I'd encourage you to do so. And all I would add to that is think about what you share in common with the people you're reaching out to. Think about whether you can reciprocate the help that you're asking for, even if that might not be obvious now because they're established in their career and you're just starting out. I had a student in this class reach out to me 3 weeks ago, interested in advice, and I was happy to share that. And actually, he ended up being really helpful, helping me understand where you all are in your decision-making process in your career right now. So there are always ways that you can help, and you'll find a much more kind of welcome hand if you're able to do that. And then lastly, recruiters. These large so-called 2 and 20 funds, the alternative asset managers, typically use third-party recruiters to find the talent that they want to interview. And they are typically targeting current banking analysts and associates, but there's nothing to say that if you have a strong finance and technical background as an undergraduate, that you couldn't actually get on their radar and try to use them for a placement. The only caveat I would add to that is that you want to be really clear and confident when you speak to them about what it is that you're looking for. Because if you go in there waffling, asking them to sort of be your mentor and your career coach, they're really not going to get that sense of confidence for you, and they're not going to want to put you in front of one of their clients, who are the asset management firm.
We're having questions in just a minute.
Oh, great, yeah.
We're going to open it up for questions in a minute, but go ahead.
This should probably come at the end. I was wondering, who's Keith Ferrazzi?
So how many folks are familiar with Keith Ferrazzi in the room? Some people, their arms are getting tired. Maybe 20%. So Keith was the youngest ever Fortune 500 CMO, and he's a fellow Yaley, New York Times bestselling author, written a lot about the role that relationships play in business. And you hear this word networking, right? Which I think all of us now kind of get a sort of unctuous feel around. It seems very sort of like superficial and self-serving. And what he's really helped elucidate is how the basic tenets of psychology, and in this respect, he reminds me of Professor Schiller, applying the basic tenets of psychology to how you actually build real, meaningful business relationships and breaking down this artificial barrier between relationships and business. Because business is relationships, as Professor Schiller mentioned. One of the things that investment bankers try to do is establish senior-level relationships because it's ultimately individuals, not entire companies, who are making decisions. So just to share a couple anecdotes about my transition from banking. After banking, as I said, I knew I wanted to work in tech. And I very fortuitously got a phone call from a lifelong friend of mine around that time who was an engineer who had started working at Facebook. And what he convinced me was that I could help him and his colleagues change how people communicate. And I was pretty sort of anxious about this, pretty intimidated by the prospect of being a business guy joining an engineering company. And what he told me, and I ultimately think this proved true, is that you don't have to be an engineer in Silicon Valley to have an impact. You just have to be able to think rigorously like an engineer does. I think the training that you're doing here at Yale and then the potential training of investment banking both have the potential to serve you well in that respect. So what we're trying to do at Facebook is give people the power to share and make the world more open and connected. Pretty simple in principle, and our strategy for doing this is mapping out what we call the social graph. Now, we didn't create this. This exists out in the world. All we're trying to do is draw a mathematical representation of it, and that's basically who likes whom and who likes what. And then we push information as efficiently as possible along the edges of that graph. So this is kind of where I spend most of my day, not just over here in Farmville, but also over here in ads land. And what my role is called is local inbound product marketing. So to kind of parse that out, what we mean is basically I go and talk to local businesses, restaurants, plumbers, understand what their pain points are, what other advertising products they use, what they're trying to accomplish as a local business owner, and then basically synthesize that with data analysis and ultimately present it to the engineers as a case for what we should build next. So these are questions like, what do the ads that you see on Facebook look like? How should they interact with the rest of the product? How can we target them to make them more relevant to you? A whole bunch more. The real guiding precept here is that it's basically what Henry Ford said, right? He didn't want to build a faster horse, even if that's what his clients might have asked for. He wanted to build something that was dramatically more useful, and for him, that was a car. And for us, it's something that we call social advertising. Happy to chat a little bit more about that during questions if folks are interested. So finally, just to kind of compare these two roles and how one might have prepared me for the other, I think the three things from banking that have served me best working on internet products are one, this is cross-functional process management, which is a ubiquitous part of the business world. Two, building polished presentations, this one notwithstanding. And three, being resourceful about tracking down data points to help make the right decisions. On the hand, there's some parts of the job that were totally new, thinking from the mindset of the CMO, the Chief Marketing Officer, rather than the CFO, the Chief Financial Officer. Just the pace of the environment. Banking is fast-paced, but the rate at which products evolve in the internet is dramatically faster. And the fundamental job itself, which is basically creating new products, building the business case for them, validating that case with data, trying to actually mock them up, and I assure you I'm not good in Photoshop, and then actually use those mocks in that case to inspire engineers and product managers to want to build them. So it's an environment that is much more ambiguous. The yardsticks for whether or not you're going in the right direction, especially in the short term, are not nearly as clear. But if that's actually something that's appealing to you, then I'd strongly encourage you to check out jobs around Silicon Valley and especially at Facebook. So you can actually go to facebook.com/careers, quick plug, to check out both the internships and the full-time jobs that we have available. So Professor Schiller, did you want to use the rest of the time for questions?
Well, yeah, I'm opening it up to all of you for questions. Okay, you have a question back there?
Before you did your junior summer investment banking, how did you even know you wanted to enter?
I caught some of that, and then the screen caught some of it, so just bear with us for 1 second, and then I'll be right with you. You said before I did my junior summer, what did I do?
Before you did your junior summer, or like, how did you figure out that investment banking was built and what you?
Well, I knew that some of the stuff on the right-hand column of the ROI chart was stuff I was interested in. I was interested in the technical side of the work, working on math basically, but also interested in the relationship side of it, the strategic side, thinking about basically how you help these companies bet the company decisions. And during the first week of training, one of the partners of the firm came in, and we use this term partner kind of as a term of art because, as the professor mentioned, no longer a partnership. But he came in and said, when our clients want to do really important things, they come to us. And when they want to think about important things, they come to fill in the blank name of top-tier consulting company. And that kind of action and actually physically seeing the results that you create in the world was really appealing to me. And I hadn't done Strength Finder yet at the time, but I did it subsequently and found, not surprisingly, that that's kind of where my psychological reward structure was kind of geared towards.
Tommy?
Hey, so Peter Thiel, who was the first investor in Facebook and is currently on their board, is now offering 20 people under the age of 20 each $100,000 to drop out of school for 2 years and start their own companies. And since you actually work for Facebook, I was wondering what you thought of that.
Yes, I think that's fascinating. And obviously I don't work with Peter Thiel. Look, I think whatever we can do to promote innovation is great, right? Now, if you're sitting here in this room and saying, well, do I want to take this risk of sacrificing the signaling device of this college degree and also potentially sacrificing some structured classroom experience in order to kind of rapidly accelerate how quickly I get into entrepreneurship, I don't know. That's a personal decision that is for you to make, and I don't really have any opinion on it. Ultimately, for me, it'll come down to, do these companies actually end up doing really cool things and building really cool stuff?
Can I add, it isn't as risky as you might think, because Yale will take you back if it fails in a couple of years.
One of our very early employees was a Yalie who had an undergraduate experience somewhat like you're describing, where I think he'd actually taken some time off to work on startups. I think he came back, finished his degree, and is now a partner at Benchmark, one of the firms I had on that slide.
But while they're thinking, can I ask you, I emphasize the core values at Goldman Sachs. And it strikes me that Facebook is totally different, or maybe I'm wrong. Can you tell me what are the core values at Facebook? I mean, if I were to read that list that I just gave you from Goldman Sachs, how would it sound to the Facebook people?
Yeah, so I think there's similarities and differences. I think each of us has a core constituency who we wake up thinking about them, go to bed thinking about them, probably dream about them, and know that whether or not we serve that constituency will determine the success or failure of the company. And at Goldman, that was the clients. And at Facebook, our number one focus is the users and the user experience. And we care a lot about our partners, we care a lot about our advertisers, we care a lot about everyone in the ecosystem, but ultimately we know we have to serve the users well. So each company, I think, has almost a maniacal focus on serving one core constituency, albeit they're different. Now, in terms of the day-to-day experience, I do think they're quite different. I think that what I'm doing now is quite a bit more creative.
You're not doing spreadsheets.
A little bit, but not as much. And I really love the creative side of the work. If you think back to from Stephen Schwartzman's lecture where he mentions that there's no flexibility for getting the numbers wrong. I mean, certainly we feel that the same way. All the analysis needs to be correct. But there's almost an ominous tone when he says that. Whereas the way that we operate is knowing that we have to move really fast in order to continue to innovate, and continue to stay relevant. And so that means that sometimes you make mistakes, and it's no secret that we've made mistakes, and some of them have been big mistakes. And we just try to minimize the number of times that happens, try to fix them as soon as they do happen, and just be honest about them and admit them when we make them.
Could I ask a question of the class? You set the example. How many in this class are engineering majors? Not many. What, like 5% maybe? What about science majors? That looks like 10%. But you see, you're kind of an engineering company, right? I mean, I don't know exactly what Facebook is, but you were. Oh, is there some kind of division here? I mean, why aren't there more engineers in this, in this class? And is there,
That sounds like a question for the class. So,
yeah. Well, I can't ask them because they're not here.
Are not in the room. Why are you not in the room?
But I mean, is there? It seems like, is there a big cultural difference? I mean, are engineers prejudiced against us finance people? Or you're there, so.
Look, I think that product design and software engineering is at the heart of the company. But as I mentioned, I was pretty intimidated going in, saying, like I'm going to be a business guy here. Am I not really going to be able to have an impact? And I think the things that are important for the business people are, one, to remember what the core mission of the company is, which for us is really all about the users. Two, to have a sense of what is feasible, right? So you don't actually have to know how to write the code or even necessarily how to mock up the product. But if you're making recommendations that we should build things that are simply technologically not feasible, you're going to waste people's time and lose credibility pretty quickly. And then three, I think when you do the analysis, engineers are going to want to see as rigorous analysis as possible, quantitative analysis when that's relevant, when that's possible. And to the extent that you can bring that to the table, I think that's helpful. If you think about the business world at large, one of the things that's just going to be increasingly important is the ability to design, conduct, and interpret statistically significant, valid experiments. And this sounds like a pretty straightforward thing that you might learn by maybe second or third year of college. And yet you get out into the business world and you'll find that many of your colleagues, whether they're coming from MBAs or other backgrounds, may not actually have that background. And so being able to bring that sort of rigor to the table, whether it's at a consumer internet company or an industrial company, anything else, I think is very helpful.
I'm thinking maybe I should change the name of this course to financial engineering. That would bring in the others. Because it is to me, engineering and finance have a certain connection. They're both designing devices. I think we have another question.
Have you thought of going back to graduate school, and how do you see that playing into a career like investment banking?
So yeah, I have thought about going back to graduate school. I think that all of us want to be lifelong learners throughout our career, right? And there's a number of ways you can do that. Graduate school is one of them. Another is going into industries where you're just confident that everyone you're working with is really smart and they're going to push you hard and not settle for mediocrity. So you just know you're going to learn by that pressure and that osmosis. And then I think there's some kind of simple structured things that you can do as well. I threw a slide up of a couple that you can kind of do in the comfort of your own living room, Myers-Briggs and StrengthsFinder. But then also you can leverage having a workplace to do things like peer coaching, career coaching, executive coaching. So I kind of take a somewhat agnostic point of view as to which of these tools I'm going to use at any given time. I just know that I constantly want to be challenging myself and constantly want to be learning more.
Okay.
I've heard a lot about issues with click-through rates on various social networking sites. So if you could talk about what you think the putative value of Facebook should be and whether the current valuation is appropriate.
Yeah, so happy to share a little bit about click-through rates. I'll probably defer on the question of how much the company should be valued at. Is everyone familiar with what a click-through rate is? No, not everyone. Okay. So this is just a simple ratio. It's, let's say you show an ad some number of times to users on the internet. It's the ratio of the number of times a user clicks on that ad to the total number of times you showed it. So if you show an ad 100 times and you get one click, you have a 1% click-through rate. And if you think about, well, why are people advertising, right? In marketing, there's kind of this concept of this marketing funnel, right? Which is a little bit silly, but it actually conveys a useful concept. Up here is kind of like everyone in the world. And then here is like the people we can actually make aware of our product. Then here's the people who we can actually make kind of have an affinity for our product. And here is the people who we can actually make consider purchasing our product. And then people who actually buy it. And then repeat loyal customers who buy it more and more. So we get to a narrower and narrower pool. And what marketers are kind of constantly trying to do is push people through this funnel so they can actually start with someone who may not know about the product at all and then actually get them to buy it again and again. And so marketers use a variety of different tools, right? Online advertising is one, but that represents maybe 15% of the market, but it's a relatively new one. And there's plenty of others that go back decades or centuries, things like television, radio, print. And these different media play different roles in getting people through this marketing funnel. And if you think about where online advertising originally grew up, it was really towards the very bottom of this funnel of, okay, I am looking for a blue iPod at the best price that I can either order online or that it's within 5 miles of my home. So I search that on a search engine. I see a list of vendors. And in that case, it's really important whether I click through because that's basically determinative of whether or not we get them through the next stage in the marketing funnel. If you think about Facebook advertising, that is one of the roles that it can play, but it can also actually play throughout this entire marketing funnel where we have a reach of 500 million people, and then you can target within that. And then you can use things like social context telling you that your friend might really love a product to help build your affinity for it on through this whole funnel. So for some of it, click-through rate is relevant. For other of it, click-through rate really isn't relevant. And you need to think about other sorts of measurement, things like companies like Nielsen do, like polling people and asking them, okay, you saw this media. Did it increase your likelihood to buy this product? Or did it make you aware of the message that the brand's trying to convey that you weren't aware of before? So I think it's one of a number of metrics that kind of go into assessing the health of the business as a whole.
I think we're essentially out of time, but let me just say, click-through rates and marketing sound like profit-oriented, but it seems to me they have a social purpose. One thing is that capitalism is being transformed by this kind of thing because it gets people to buy things that they really it's like your strength finder or needs finder. And I have to applaud Facebook and other companies. But finally, I'm going to invite you back in another 10 years. All right, this was great.
Okay, thanks.
Institutional investors today. I don't know if that sounds like an enticing topic to you. Institutional sounds boring. But I'm actually talking about people who control much of the wealth of the world. And they have a lot of influence and importance. So I think it's worth considering them and considering it's really part of the governance of the world. How do things happen? Who decides? What is going to happen? What's going to be done? Increasingly, it is professional institutional investors. They're kind of unseen mostly, and I guess they don't make movies about them. So not that I've ever seen. Someone tell me if there is one. But they're very important. So I thought I would start by just talking about the importance of, in this lecture I'm going to include both people who manage money for institutional portfolios and also financial advisors and financial planners. They're a very big and important part of the world economy. But I wanted to start by just giving some perspective on them by looking at what it is that we own and what they manage. So I thought I would start for the United States and show a list of everything that's owned, okay? And I got this from, this is from table B100 of the balance sheet for the American economy, produced by the Federal Reserve Board in Washington. So it's really a sum of everything that people own in the United States. And the point I'm going to make from this is that institutional investors are quite prominent on this list as managers of it. But let's just first look at the total. This is 70,740 billion, or let's say $70 trillion is it. That's everything that anyone owns in terms of assets that the Fed can measure. Of course, there's all these priceless things that we all own, but not on this list. But so what are they? Well, number one is real estate. This is owned by households. Actually, they lump in nonprofits, unfortunately, because nonprofit organizations are like people, because nobody owns them, right? So this is the sum of everything that the ultimate owners own. So it's everything. But nonprofits are a small part of the total. So real estate is 18 trillion. That's real estate owned directly by households and nonprofits. It doesn't include commercial real estate that are owned by some of these other things. But that's not held by institutions. That's held directly by households. But the next item on the thing is pension funds, and that's 13 trillion, almost as big as real estate. And what are pension funds? These are plans that either businesses create for their employees or that people invest in themselves for retirement. It's planning for old age. Then there's equity in non-corporate business. Non-corporate business means family businesses. We're trying to, well, not necessarily family, but partnerships and family businesses. The corner store is a business. It's worth something. The Fed has estimated the total value of all of these non-corporate businesses and estimates them at $6 trillion. Again, that's not institutionally held. That's held by families and people. So far, we've got more family than institutional. But then if you keep going down the list, deposits are deposits at banks, $8 trillion. That's savings deposits, time deposits. Now, that's institutional investors managing that. Corporate equities, now this is shares in corporations owned by households. That's $8 trillion. Now we're back to households owning them directly. But then we have mutual funds. Mutual funds are investment funds for the general public that invest in equities and sometimes bonds and other things. And that's almost $5 trillion. Consumer durable, we're going kind of, it seems like half and half, maybe a little bit less than half are institutional, but it's a big share so far. Consumer durables, about $5 trillion. That's your cars, your clothes that you're wearing, whatever else is in your house is estimated at $5 trillion. Treasury securities are, now that's government bonds. It might surprise you that it's only $1 trillion. That's because that includes both savings bonds, which your grandmother gave you, right? I don't know if you got that. You got $100 savings bonds. Maybe you did, but that's only $100, right? It doesn't add up to much. There are big-time treasury securities that are treasury bonds, treasury notes, but they generally are held by institutions. Not households just generally don't buy them. The total national debt is now in the United States is $14 trillion, but only $1 trillion, that's only 1/14 of it, is held by households. So the institutions hold the rest. Well, foreigners hold some of the rest too, but we're not counting foreigners here. Corporate bonds held directly by households, $2 trillion. Municipal bonds held by households, $1 trillion. But I'll come to this. The total municipal bonds outstanding are more like $3 trillion. So households don't hold them generally. except indirectly through institutions. Life insurance, these are reserves at life insurance institutions. That would be institutional investors again. So it seems like less than half, but close to half, of all of the assets in this country are held by institutional investors. This is a change from 100 years ago. 100 years ago, virtually none of it would be held by institutional investors. So our society is becoming more institutionalized. More and more things are being done by professionals. And a related thing I want to mention again is that as society gets more modern, the importance of the family is diminished, and the importance of government and business are increased. So for example, pension funds are taking over what used to be a family responsibility. When grandma and grandpa get old, they move into your house, and you take care of them. That's an extra financial thing that has gone on from time immemorial. But now it works differently. Grandpa and grandma commit to a pension fund, contribute to it. When they get old, they move to an assisted living facility, which is a place where maybe they're happier. I don't know. At least they can choose. And they don't have just the single choice of living with you, which they might not like. They might like it, they might not. But it's working more institutionally. So this is really, I wanted to talk about thoughts about where our society is going and seeing the increasing professionalization of it. I thought to complete this list, I should remember, with the previous slide, I said, this 70 trillion is assets owned by the households, okay? But I just wanted to get you in the right perspective on this. What about liabilities, okay? The Federal Reserve Board computes that too. So these are, those assets are owned, but it's not net worth of households because the households owe money too. So the biggest debt that households owe is, in the United States, $10 trillion of home mortgages, all right? So we saw they have $18 trillion of real estate, but they owe $10 trillion so that they have a net worth in real estate of only $8 trillion. But moreover, consumer credit is $2.4 trillion. That's credit card debt and some other revolving debt like department store cards, or when you buy something, when you buy a car on time, it would go into that total. So the total liabilities are $13.9 trillion. And then, so household net worth is the 70 trillion assets minus the almost 14 trillion liabilities. So it's 56.8 trillion is the total assets. And in per capita terms, that's $184,000. So, that makes it out like, that would mean that the average family of four has about 800, I'm just multiplying 184 by 4, it's almost $800,000. So we're a country of millionaires, I guess. We're soon to be. But the problem is it's only on average. Most houses, this is unequally distributed. But I should also add, the U.S. government has a debt of, as of this morning, I looked it up on a national debt clock, 14.286 trillion. And that's not counted as a liability of households, right? But it should be, because we have to pay it, and we're going to pay it through our taxes, right, eventually. So you might subtract off another 14 trillion from the 56 trillion. And then let's not forget, there's state and local government debt, right, which is another 3 trillion. So what does that bring us down to? Something like 40 trillion or less. I wanted to do that just to get perspective on what our assets and liabilities look like. The other thing is, I'm trying to put things in complete perspective. So I wanted to talk also about something that's not on any of this, and that's human capital. Human capital is the value of our people and what people can do and produce. And if you want to develop total national wealth, you would want to include human capital as well, right? So what is the national wealth for the United States if we include everything, okay? Well, the way I figure that is, right now the national income, U.S. national income, is 13 trillion a year. And I want to capitalize that to a value, to the present value of that. If you assume 3% growth in real terms and a 5% discount rate, that would make wealth equal to 13 trillion. I'm using the Gordon formula, divided by 0.05 minus 0.03, or 260 trillion. That's also just for perspective, because I just wanted to put this 40 or 50 trillion in perspective. I'm kind of diminishing my lecture. I'm telling you institutional investors are important, but as a fraction of the total national wealth, it's not that important. And I think the family is still very important as a manager of our wealth. This is managed by, not managed by institutional investors. One more calculation that will diminish the importance of institutional investors even more. What do you think the world is worth? All right? If we were to take the total national income of the whole world and take the present value of that, well, according to the International Monetary Fund in Washington, which estimates for the world national income in 2010. Well, world income. Actually, this is world GDP, I believe, but I'll use it as a proxy for income, is 62 trillion. And if I use the same discount rate and assume growth rates, you know what I get for the value of the world? The world wealth? It's 1.2 quadrillion. All right, so I just, again, put things in perspective. We are going through an enormous transition in the world. I'm only assuming a 3% growth rate for the world, and many countries are growing at 7 to 9% now, so maybe this is conservative. But I think that as the world matures, as we become more and more modern and capitalist, the importance of the family will remain important, but it will diminish in relative importance. So as time goes on, we're going to see something like $1 quadrillion increasingly managed by institutional investors. So that's what I want to talk about today. So as I was saying, in modern society, we do things differently. We don't expect young people to take their parents in to care for them. I mentioned that as an example. Is that because we don't care about our parents as much as we used to? Interesting question. There's a lot of discussion about that. But my general take on it is that most elderly people like to have choices. They love their children, but they don't want to move in with them. They want to have a savings, some kind of pension. They want to be able to choose how they live, with whom they live with. Similarly, our health care. We used to depend on our families to provide health care, but it didn't work very well. People weren't getting very good health care. And now we have it all institutionalized through trust funds for health plans and benefits and the like. So this means that it's more and more run by investment managers. And investment managers are trained in modern finance and understand risk management. So there's a professionalism to all of this. The family is of limited, even if it were smart, even if they were brilliant as investment managers, they're a small unit. And unless they were to engage in some kind of risk-sharing agreement, they can't manage risk well. The whole family is too small a unit to manage risk. But increasingly, investment managers are running risk management for families that allows risk-sharing around the world. We have growing pains with this. The recent financial crisis shows that investment managers mess up sometimes, and their attempt to share risks around the world, like, for example, the subprime crisis was caused by the failure to manage mortgage risk appropriately. But nonetheless, I think they're getting more professional and more important. So right now we have professional risk managers that are, I think, increasingly important in our very lives. Now, they have a fiduciary duty. If you are managing other people's money, that's a quote, other people's money, then you might be negligent. It's not my money, what do I care? So the law prescribes that you, as an investment manager, have a duty to act in the interest of the person you're managing for, or of the group of people you're managing for. And the law has been trying to prescribe what this duty is. There is something called the prudent person rule, which is a rule that investment managers have to behave as a prudent person would. I'll read one definition of it. ERISA, which was an act of Congress in 1974, defined. They called it prudent man rule back then because our language was still sexist in 1974. They said that investment managers running pension funds must manage with the care, skill, prudence, and diligence under the circumstances then prevailing that a prudent man acting in a like capacity and familiar with such matters would use in the conduct of an enterprise of a like character and with like aims. Okay, they're trying to legislate what it is to be a good fiduciary, and it seems sensible. You should ask, if someone is managing a pension fund for elderly people, they shouldn't do wild and crazy investments, right? They shouldn't invest in racehorses or something like that. Should be prudent. But then how do you define it? If you read the act, it says they would be acting like a prudent man in a like capacity, in a conduct of an enterprise of a like character and with like aims. The problem is, with the 1974 Act, is that it's hard to legislate duty, define what it is. So what the law said, and it has said in many places, is that you have to, as a fiduciary, as an investment manager, you have to act as a prudent person would act. And what is a prudent person? I guess it's somebody else. Somebody else who is of a kind of a standard, ordinary type. I don't know what it is. I mean, I could say that investing in racehorses is the smartest thing for me to do, but I can't claim that that's a prudent person act. So the law has required institutional investors, to some extent, to behave as, not as they would behave, but as they think other people would behave. It was legislating a requirement that you don't do what you think is smart, you do what you think other people think is smart. And this has been a problem because what it has done is it has created a class of institutional investors who live in fear of laws that could come down on them if they, with the best of intentions, invest on behalf of their clients in an unconventional way, and therefore could be punished for violating the prudent person rule. Thus, for example, because of the prudent person rule, university endowments, which are an example of institutional investments, for much of the 20th century were invested in bonds, government bonds, because they thought, well, that's prudent. No one can tell me that we're not prudent. The government bonds is safe. But some investment portfolios, notably the one that we had David Swenson come and speak to us earlier, took a more aggressive interpretation of the prudent person rule and developed developed an investment strategy that looked imprudent. So, for example, Yale University was investing in startup .com firms during the .com explosion, managed to sell out just at the peak. Is that being a prudent person? Well, the interpretation of prudent person rule has changed. And this is part of the phenomenon that drove the bubble. Institutional investors, led by people like David Swenson, led to a more benign interpretation of the prudent person rule and allowed them to take chances. And I think that general sense that one could be more aggressive in investing was part of the bubble that led to the financial crisis. I'm not saying it's a bad thing in itself, but I'm telling you it was part of the factors that led to this bubble. I looked through Dodd-Frank. The Dodd-Frank Act of 2010 is the most important piece of financial legislation in the United States since the Great Depression. And I did a search for prudent person. It appears nowhere. But I found that the word prudential standards appeared 34 times in the Dodd-Frank Act. So it seems like the financial crisis is changing things a little bit. It's bringing our society to want regulators, government regulators, to be making the ultimate decisions about what kind of risks institutional investors will take on. They're still letting households do what they want, but in terms of institutional investors, the Dodd-Frank Act talks extensively about regulators going in and regulating what institutional investors, what kinds of risk they can take. The same thing is true in other countries. I think this is a world phenomenon. The problem is that the prudent person rule didn't seem to work. It didn't seem to work well enough. It started out when it was first imposed as encouraging a very conservative investment, but then people thought as time went on that didn't make sense. They got more loose, and it led to a financial crisis. So Dodd-Frank is creating something called the FSOC, the Financial Stability Oversight Commission, which has to enforce, well, it doesn't enforce, but it makes recommendations on prudential standards, particularly regarding, well, I'd say particularly, but including leverage. Leverage, we talked about, is the amount of money you borrow. Well, it's measured. It's a measure of the risk that you've imposed on your portfolio by borrowing to buy assets. The economy became increasingly leveraged up until the financial crisis when it began around 2007. And people are concerned about that. Well, were our institutions following the prudent person rule? Well, somehow, as time went on, their mind allowed more and more leverage to be considered acceptable. So that now what we have in the Dodd-Frank Act is that the Financial Services Oversight Commission is supposed to recommend standards of leverage and prudential standards for financial corporations, and to put financial corporations under increasing regulatory authority to meet those standards. So in some sense, it's shifted to the government. We had seen a historic shift of power over investments from individual investors to institutional investors, and to some extent, at least, it's shifting to the government. Okay. And I think this, I'm talking mostly about the US, but I think this is a currently worldwide trend. You know, it's exemplified also, I mentioned before, that we had private organizations, the securities rating agencies, such as the Moody's and Standard & Poor's and Fitch, but the government are trusting them less, and they're putting standards more on government regulators now. I said I would talk about financial advisors. Financial advisors are people who don't directly manage portfolios. They're not institutional investors, but they give advice to those who do. The financial advisors are regulated by governments in most countries. So in the U.S., for example, the SEC, the Securities and Exchange Commission, requires advisors to be approved by FINRA. To win FINRA approval, where FINRA is the successor to the National Association of Securities Dealers. It's a non-government organization that administers an examination and education program for advisors. And so you effectively have to go through FINRA to get licensed to be a financial advisor. Okay. I'll give you an example of an organization of financial advisors. NAPFA is the National Association of Personal Financial Advisors that manages the relation between financial advisors and the public. So these people will typically charge between $75 and $300 an hour, and you can get one tomorrow. Just make a phone call, get on the website, NAPFA website, and hire one. And they have a code of standards. They have to be licensed through the SEC, and they have to have a code of standards, oath of loyalty to the client that they undertake. This is a big business. I'm mentioning it because I think I gave some, in one of my first lectures, I gave you a count of how many people there are. But I'm just trying to, there's also something else called a financial planner. Financial planners. Now, it sounds like the same thing to me, but somehow if you call yourself a financial planner, you don't have to go through this licensing. The Dodd-Frank Act, I didn't find much new legislation regarding them. The Dodd-Frank Act is calling for a study of financial planners. The question is, how does the government get involved in making these people give good advice? The problem is that the financial crisis seemed to be led by a lot of bad advice given out. A lot of people were encouraged to leverage up their ownership in their home, to borrow heavily to buy second homes. I'm sure that financial advisors were not uniformly advising that, or financial planners, but there's a concern now about what kind of advice people were given. So in 1996, Congress passed a bill in the United States saying that financial advisors cannot be convicted felons, among other things. But there hadn't been, until then, such a law. We have something else called mortgage brokers. It's a little different. These are people who give advice on getting a home mortgage. There was no licensing of them until the financial crisis, because mortgage brokers could be anything. They could even be a convicted felon until just a few years ago, until after the crisis. Here's the fundamental problem, that people are they're confronted by an increasingly complicated financial structure. Living is less family, and it's more investing and getting involved in financial markets, and most people don't know how to do it, and that the people who give them advice are often not giving them the best advice. What can we do about that? Well, the government is trying, but it's imperfect. I think that as the world develops, I think we'll probably see, I think there is a trend toward increasing professionalization of these groups. And although it's not a simple matter to straighten out some of the irregularities, we're moving, as the world gets better and better, to even stronger such institutions. Now I wanted to go through some kinds of institutional investing, and I'm probably the mutual fund is, I've talked about this before, is a investment company that is owned mutually by the participants. It will invest typically in stocks, and it distributes everything to the owners of the stock. The first mutual fund was the Massachusetts Investor Trust. That's not the university. Massachusetts Investment Trust, which was founded in the 1920s. And it was very open and direct with its investors. It published its portfolio. It was completely open about what it did. And it promised nothing more than it would divide up all of the returns among the participants. There were no senior members who got more of the money than anyone else. So MIT became a model for an investment fund for the public. In the 1920s, there were many investment funds that were were exploitative of the public. They had two classes of investors, and the first class of investors ran off with the money at the expense of everyone else. So it took a while after the 1929 crash, but the Investment Company Act of 1940 set the stage for the growth of mutual funds. And so mutual funds are designed for individuals, and they are, this is the US. They're a very successful institution. So you know exactly what, they have regular reports, you know exactly what they're doing, and there's no rich person benefiting excessively from what happens. In Europe, they have an analogous institution, UCITS. It refers to a European Union directive called the Undertaking for Collective Investment in Transferable Securities, which is an EU directive, 1985, and then they had revisions in 2001, that creates a standard investment fund like a mutual fund for Europe. It used to be that every European country had its own securities law, and it made it difficult because there's so many European countries. So they standardized and it developed a sort of European version of the mutual fund. The key difference, I think, between a mutual fund in the US and the UCITS in Europe is it's technical. It's how they're taxed. The mutual fund in the United States, if you own shares in a mutual fund and you just hold them, you will still get capital gains taxes every year, even if you didn't sell it, because other people in the mutual fund sell some of their shares, generating a capital gains, and that capital gains is then distributed to all of the participants in the mutual fund. With the UCITS in Europe, you don't pay capital gains taxes unless you yourself sell. So I think the UCITS form is gaining on the mutual fund form. And some people, notably Robert Posen at the Harvard Business School, is advocating that the US switch to the European standard. Okay, I want to talk about trusts. Okay, what is a trust? It is a money held on behalf of another individual. Well, particularly a personal trust is something that you can set up on behalf of another person or a cause, so that an institutional investor will manage money on behalf of that person or cause. And a company that does trust is called a trust company. And trust companies have often been combined with banks, but they're not necessarily part of a bank. And you'll see many institutions, the title will be Bank and Trust Company, okay? Well, you know what a bank does. It takes deposits and makes loans. What does a trust company do? It creates trusts on behalf of some person and manages the money for them. The classic example of a trust is, imagine that you have a child who is handicapped in some way and unable to manage his or her own affairs. And you, as a parent, know that the child will outlive you. And so how do you provide for the child after you are gone? Well, you create a trust for the child. And you can go to a trust company and say, I want an income for my child managed for the rest of my child's life. And the bank will outlive you, or the trust company will outlive you, and you can do that. So this is very important because it allows people to create situations that outlive them. But in particularly in common law countries, it doesn't have to be a company. You can set up a trust. You can take a young relative of yours who will outlive you and say, I want you to be the trust manager for my child. And if you become ill, can you appoint a successor? You can do that too. U.S. trust law recognizes the importance of trusts. And so that person, suppose that person that you appoint as a trustee for your child, suppose that person goes bankrupt and then other people are seizing that person's assets. They could not take the assets in the trust, all right, because the law recognizes the importance of trusts. There are different kinds of trusts. I thought I should tell you about a particular kind that may be relevant to some of you in your future. There's a certain kind of trust called a spendthrift trust, which is a trust that your parents may be setting up for you now. I don't know. What is a spendthrift? A spendthrift is someone who spends money too freely, all right? Can't be trusted to manage money. Suppose you have a child who's like that, and you're getting on in years, and you're thinking that you could leave a will to your child, right? But the child might just blow it. Or, so what you do is you go to a trust company, and you say, I'd like to set up a spendthrift trust for my child, and after I die, the trust will pay my child an income, and the child cannot get at the assets, only the income, all right? And so you manage it, and the child comes to you and says, I want the money, and you say, sorry, your parents set up a spendthrift trust. That's all you can get. There's various reasons why they do this. One of them is that in a divorce, if your child gets divorced, if you gave money to the children, the divorce court might give half of the money to the awful spouse, your child married. But if it's a spendthrift trust, they can't get at it. It's income to the child. So there's all kinds of reasons why people set up trusts. But I think trusts are really an important invention in our society. They're not talked about very much. But I mean, it solves a real problem. This handicapped child problem is an extreme case, but it's very real. You can have assurance. The law makes it clear that that money is managed by a professional for the child. Now, so these are real and important institutions that help people get on with their lives. And I think our financial system does a lot to make these things work well. I want to talk about pensions because I've already talked about them, but people do get old and they can't keep working. And if you look at the history of the world, the fate of elderly people is highly variable. Many of them, if they have good and dutiful children, will do all right, who take care of them. But in the past, you would find a lot of elderly people out on the streets begging because they didn't have children, or the children died, or the children lost their income. And it's a problem that we've worked substantially to solve. And again, it's an example of progress of our civilization. We take it for granted that people are living as comfortably and well as they are, but it's substantially a product of invention. So the idea of a pension is actually a relatively new idea. The first U.S. Pension plan was 1875. American Express Company set up a pension plan for its employees. There was actually an earlier example in the UK, I think, but I don't have the name of it here, but only something like 20 years earlier. So until then, there was never a pension plan. So American Express set up a plan, and it said employees who had worked at, this, by the way, is not the credit card company. This was a delivery company. They had stagecoaches. This is a long time ago. If you worked there for 20 years, past age 60, and was disabled, you would get 50% of the average of the last 10 years' pay for life. So this was a model, 50% of last 10 years, of average of last 10 years pay on retirement, because it was tied to how much income. You thought you could live on half the income that you earned when you were working. In 1901, Carnegie Steel, that's Andrew Carnegie, the same Andrew Carnegie who wrote The Gospel of Wealth that we've been talking about, gave this was the first large industrial pension fund, and it covered a substantial number of people. It was a milestone that suggested many more such pension funds. Unions in the early 20th century started setting up pension funds. For example, the pattern makers in 1900, the granite cutters and cigar makers in 1905, etc. So union pension funds became popular in the early 20th century. But there was a collapse of pensions after 1929. Many people were promised pensions in the first 3 decades of the 20th century, and the companies just went out of business and didn't. Moreover, the unions of pension funds failed especially disastrously. They just didn't manage their money well, or the institutional investors were not very astute. You know, it's like the world was very amateurish about how they handled these things. Obviously, it's very important that people have money to retire on, but they just many of them got wiped out in 1929. So it led to further thinking about pensions. The General Motors pension plan was a landmark pension plan in 1950. And in 1950, GM Chairman Charles Wilson proposed a fully funded pension plan. This was a new idea. That is, General Motors, in promising to pay you in your retirement, would set aside and invest now enough money so that they would have that. In other words, they created a trust for the employees. So it's just like the parent for the handicapped child. If General Motors dies, doesn't matter because there's a trust managing their pension funds. You know, it's kind of a funny idea. Why didn't anyone do that before? Why didn't the unions, who were looking out for the union employees, demand that they fund their pension funds? You know, it seems like financial history shows a lot of stupidity. I don't quite understand how it could be. It seems obvious, doesn't it, that if a company is going to promise you for a pension that they should set aside money, because companies fail all the time. There may have been some union complicity, that the unions were not really always working on behalf of their members. They thought, well, the members don't think about this problem, so we're not going to think about it either. It's going to come years down the road. We're not going to worry. So General Motors in 1950 set an example for funding the pension funds. It's very important. And more and more firms started to do that after 1950. But the next thing I want to give is Studebaker. Remember Studebaker? They were one of the major automobile manufacturers. Maybe you don't remember them because they went bankrupt in 1963. That's a long time ago for you, but they were around. Well, they had a pension plan that was partly funded, but inadequately funded. And when they went out of business, their employees lost. So this led to arguments about, and their labor union, again, the United Auto Workers, supposedly standing up for the employees, didn't do the job. So the whole idea of labor management negotiating, protecting the workers seemed flawed. And so the government got involved. And it led to ERISA, which I mentioned before, 1974. ERISA stands for Employment Retirement Income Security Act. This was an act to clean up pension funds and make them work well, make them work better. So the government wanted to make sure not only that pension plans said they were funded, but that they were really funded, so that another bankruptcy wouldn't cause pension plans to fail. So ERISA set up a new government agency called the Pension Benefits Guarantee Corporation. So that's PBGC. The Pension Benefits Guarantee Corporation is a government organization that ensures the funding of pension plans. Okay? So pension plans not only have to undergo scrutiny by the PBGC that they are fully funded, but they also have to pay a insurance premium to the PBGC. And if it turns out that they're not fully funded, then the PBGC will come in and replace the lost income. So you see how over the centuries we're trying to come up with financial structures that solve basic human problems. The PBGC, by the way, is still here, and it hasn't gone bankrupt despite this financial crisis. Though people are worried about it, it has managed to survive. After 1974, shortly after this, after 1974, a new kind of pension plan became popular. So ERISA was written in an age of defined benefit pension plans. Okay, like the original American Express pension plan. What did American Express pension plan in 1875 promise you? It promised you half of your average income for the last 10 years. All right? And if you're going to fund the pension plan, you're presenting a problem to the managers of the pension money. They have to hit that target. They're told you the pension plan has an obligation to fund the payments equal to whatever percent of last year's income. And that's kind of a tricky problem if you're a manager. How do I do that? How do I hit that target? How do I know how much money to set aside? Well, it's getting now into government regulators and prudent person rules, and it's tricky. But the point is that in 1974, almost all pension plans were like that. They defined the benefit that you would receive when you retired. But in the 1980s, companies started offering a new kind of pension plan called a defined contribution. The idea was, it's hard for us to hit that target of, say, 50% of your average income for the last 10 years. How do you expect us to do that? We don't know how much these investments will pay out. We don't even know how much money you'll be paid in your last 10 years. So, it's asking us to do the impossible. So, well, it's not impossible, but to do the difficult. So many companies decided, instead of requiring a defined amount to be paid, they would just define the contribution they'll make to your portfolio. They give you a portfolio as an employee, and you get whatever income that portfolio generates when you retire. The most famous example of that is a 401k plan in the United States. But ever since, shortly after ERISA, the world has been moving toward defined contribution pension plans, where a defined contribution pension plan doesn't promise what you'll get in retirement. So then the portfolio manager for a defined contribution pension plan doesn't have to worry about hitting targets. And in fact, the way defined contribution plans are usually set up, they give the individual employee the choice of the main portfolio allocation between stocks and bonds and real estate or whatever. But you have investment managers managing within one of those asset classes. So there'll be someone managing an equity fund, another one managing a bond fund, and they try to do as well as they can as investors, subject to the restriction of what they invest in, and it's left to the client to choose the allocation. Defined contribution plans are going through growing pains too. We still don't have the perfect system. The problem with defined contribution plans, one problem is that you don't have to sign up for them the way they've been set up. It used to be, under the old days, defined benefit plans, just automatically every employee would get the pension plan. But with a defined contribution plan, the typical rule was that the company would ask you to make contributions out of your paycheck to the plan, and the company would then match them, typically with additional contributions. But something like a quarter of the people would choose not to participate. And then that's because they're not thinking ahead. And so when they come to retire, they don't have any pension plan. Moreover, some of them take the most risky investment offered. They might put it all in the stock market. And if the stock market does badly, they might end up poor in retirement. And companies generally would not give any advice to the people who were employees because they didn't want to be liable for giving bad advice. So it led to kind of amateur investing for pension plans. There's been work to try to fix that, and I think we've now, federal legislation has made it easier for companies to give advice to employees. They've also allowed recently, in the last few years, for companies to automatically enroll employees in a pension plan and allow them to make allocations if they didn't hear anything from the employees. In other words, they'll put you into a prudent allocation, and then you're actually there. You're in it because you've said nothing. So that's working towards solving the problem. We still don't have, I think, the ideal solution to any of these things. But so I've talked about pension plans. Let me move on to endowments, endowment managers, of which David Swensen is one. So an endowment manages a portfolio for some cause or some purpose, like a university. And the history of endowments is one of great. It's just amazing to me how many serious mistakes were made in history, but we're gradually becoming more professional. So I'll give you an example of mistake. I don't know if this is in Swensen's book. In 1825, Yale University put its entire endowment in an investment in the Eagle Bank of New Haven. Okay, you know what happened? It went to zero. It ended up with nothing. So Yale had no endowment after 1825. So Elihu Yale may have given us money, and we should have turned it into a pretty tidy sum, compound interest from 1700 to 1825. But we blew it completely. This is the first thing you learn in portfolio. You don't put all of your money in one investment. But Yale University did that. By the way, looking it up, 1825 was the year that Yale College introduced the economics requirement, or they called it political economy. Before that, there were no economics courses at Yale. So maybe it was this experience that made them do that in 1825. But I'll give you another example. Boston University. This is much more recent. Under John Silber, invested not the whole endowment of the university, but $90 million in one company called Saragen, which was a genetic engineering company. Just John Silber decided to do this, and he lost Boston University 90% of $90 million. Under University of Bridgeport, not far from here, blew its whole endowment and ended up having to join the Unification Church to survive. But I think that somehow that's been undone since then. I'm not sure of the details. It may not have been what they would have done if they had had an endowment. See, what Swensen thinks is what he's doing is protecting the ability of a university to undergo its financial mission. And so because Swensen was not overly constrained by prudent person rules, because he was free to invest in a high intellectual standard, he's made it possible for Yale to pursue its educational objectives. Right now at Yale University, like other successful endowment universities, graduate students get their whole tuition paid plus a living allowance. So it's like a job coming to be a graduate student. The university you should know this if you're thinking of getting a PhD. Come to one of these universities and they'll pay you something like $25,000 a year or something like that. That's a pretty good deal. It's not a deal, it's a gift. It's the generosity of the alumni, and it's the success of the investment strategy that makes that possible. And then I wanted to talk about another kind of institutional investor. And this will bring me back to my discussion of the family. I started out by saying that the family is the fundamental unit of our society. Its demise has been predicted. You remember that in the Communist Manifesto, Karl Marx said, we're going to end the family as an economic unit, something like that. Didn't happen. It's too ingrained in our genes, or our long history. So I thought I should come back and talk about family offices. And family foundations. Although these apply only to the more wealthy people in our society. What is a family office? These are people who have $100 million or more typically set these up, maybe even less, maybe with $20 million in assets. But if you have $100 million in assets, 5% income is $5 million a year, right? That's pretty, it would be sensible to take on some full-time employees to manage your family portfolio. And so that's called a family office. I recently spoke at a family office forum down in Florida, and they seem to be very numerous. There's an awful lot of families. The families come to these conventions, and they hear people like me speak, although I'm different than most of them, because most of the people speaking there wanted to sell products. I wasn't there to sell anything, but so they typically have 2 or 3 or 5 people working full-time, managing their portfolio and planning things like trusts for the children. And then there's something else called the family foundation. The family office is for the family, and there's something else called the family foundation. And this is different from a family office, but they could be interrelated, and I think most wealthy families have both. A family foundation is a charitable organization created by a family with the name of the family typically on the foundation. It's I think that most wealthy families, or actually, I don't know, a large number of wealthy families, at least in the United States now, set up family foundations. And the reason they do that, well, why do they do that? I think it's partly because when you're wealthy, you realize that you can't spend it all on yourself. And you reflect on yourself as a member of society. As people get older, they think, what am I going to do with this money, you know? And so increasingly, people are setting up family foundations. I learned that as of 2006, there were 36,000 family foundations in the United States. And it's growing rapidly. There seems to be a trend toward that. I think we're reflecting our increasing affluence, but I think also reflecting maybe changing values. So the typical family foundation is not huge. It might be $1 or $2 million, right? So you can set something like that up eventually, if not right now. I want you to think about doing that. So whatever it is you believe in, you set up a family foundation to do that while you're still young, and you get it going, and it will then outlive you. And you endow it. You give it enough. Say you give it a couple $1 million. That would be a small family foundation, but you can do that. And then there's some named cause, like it could be improving neighborhoods in our city or the like. And family foundations, I think there's an important tax advantage. And you don't want to think about this yet, but you should start thinking about it. When you start making money, assuming that happens, what do you do with it? Okay, now you're pulling in $1 million a year. Okay, that's something that you might well do. And so I can just put it in the bank and not think about it. One problem is the government will tax you on it. And you get a charitable deduction from your tax, which encourages you to give to charities. So all right, so you're now 30 years old, and you're making $1 million a year. And what do I do with all this money? I'm paying taxes on it. If I give it away, I get a tax break. So there's an incentive to give it away. You're getting all these phone calls at night from, they found out that you exist, right? From United Fund or different charitable organizations. But you stopped answering the phone because you're annoyed by all these phone calls, and you're thinking, I don't want to just give it away to someone that called me up on the phone. I want to think about what I want to do something for the world. So the idea is that while you're still young, you set up a family foundation, and you give the money to the foundation irrevocably, all right? It has a cause written in its charter, or and then you don't have to spend it now. You're too busy thinking about what you're doing. So you start contributing to the family foundation, and it accumulates. Meanwhile, you're getting the tax deduction. So that's why 36,000 families have done this in the United States. And I think it's growing, again, over all the world. Sometimes family foundations are plans for children, too, because then your children can then run the foundation. So it becomes an ongoing thing for the family that unites them in a cause as time goes by. I think this is really important to recognize this trend. Although it's only 36,000, that's still a lot of them. As we think about the growing inequality in the United States and in other places around the world, and think about our policy toward that. I think we should do something about inequality, but I think encouraging this kind of family foundation activity is a good cause. I wanted to just think about it, and I'm almost done here. There's a recent book by a Wall Street Journal writer, Robert Frank, called Richistan, and he talks about rich people in America and what they do. And the book, this is Robert Frank. The book talks about excess that some people do. Some rich people spend money lavishly, and it disgusts people who think, what is going on in our society? But on the other side of it, there is also this philanthropic trend that Frank talks about. So I'll give you an example. Robert Frank talks, for example, about Paul Allen. Remember him? I guess he was the number 2 man at Microsoft. So is he a good person? Well, I'll give you 2 sides to that story. And this I got from Richistan. Paul Allen wanted to have the biggest yacht in the world. And so he went to a yacht company and had a 400-foot yacht. Okay, It turned out, they said, that it created problems for him because he couldn't dock it at any yacht club. He had to go to industrial docks for major cargo ships. So that's a big yacht. And he called it the Octopus. Okay. And Paul Allen has a new book that just came out. It's just coming out now, called Idea Man. And in his own account of himself, he had brutal battles and arguments with Bill Gates. It was a revealing thing. They were really in this for the money. Okay. So he's starting to look like a bad guy, right? Because here he is showing off with the biggest yacht in the world. Actually, he's been topped. Somebody else, who was it? Larry Ellison got a 450-foot yacht. But on the other side of it is, there is something called the Paul G. Allen Family Foundation, which he has set up already. And it turns out he has already donated over $1 billion through this foundation and otherwise to charity. So that's much bigger than the 400-foot. What does it cost to buy a 400-foot yacht? I don't know. It's not going to be $1 billion, right? This is one of the ironies that you face in living, that someone like Paul Allen, he's a tough businessman, aggressive guy. He sometimes does extravagant expenditures, but on the other side, there's this charitable side. So I think we have to reserve judgment about most people. Anyway, what he has working for him is a great understanding, apparently, of financial arrangements, of endowments, and he's setting these up, and we've got to give him credit for that. And I think we have to consider that it's an important, institutional investing is an important trend in our society that can and clearinghouses, primarily stock exchanges. So these are places where shares in corporations are traded. And I think it's good to devote a whole session to them because exchange is central to economics. In fact, I was struck recently, I was rereading the presidential address of my old teacher. When I was an undergraduate at the University of Michigan, I took a course by Professor Kenneth Boulding. And then I suppose I'm influenced by him. But he gave when he was elected president of the American Economic Association, he gave a talk about economics. And he had an interesting definition of economics. What is economics? There's a lot of definitions given for the field, but one definition is the theory of the allocation of scarce resources. Right? That's by some definition what the essence of economics is. But Boulding said that doesn't sound right to him because political science is about the allocation of scarce resources, and so is even the family is an instrument of scarce resources. So Boulding said in it was his 1969 presidential address that economics is the study of exchange. All right. Obviously, it's prices and quantities that economics emphasizes, and those are parameters of an exchange. So we'll say that equals economics. I'm reminded of another book. I'm talking in very general terms first, and then I'm going to focus in on stock exchanges. But I'm reminded of another really important book which I read so many years ago by Carl Polanyi called The Great Transformation. And that was written in 1944. What is the Great Transformation? Well, for Polanyi, it's the invention of exchange. He said, what is the most important invention of man? Maybe it's exchange. According to his history of humankind, this was a relatively recent invention, Neolithic or more recent than that. He argues that in primitive societies, there is really no arm's length exchange. An arm's length exchange is one where you just quote a price and a quantity, and you don't have any other business. You know, the price and the quantity sum it up. It's a business transaction. But Polanyi argued that until just something on the order of 10,000 years ago, there were no business transactions. There were only gift exchange. There were relationships people had. And you would solidify a relationship by making a gift to someone else, and then that person would later reciprocate. But there's no price, there's no exchange. So he claims that the development of our civilization is really the result of the development of the idea of exchange, and then an amplification of the idea as it became more and more pervasive. By the way, I've since learned, I thought Polanyi was very impressive, but some anthropologists question whether there wasn't exchange more than 10,000 years ago. And they cite evidence. One kind of evidence that's found of this is that certain commodities, even into Paleolithic times, certain commodities are found far from where they were mined, like flint to make stone tools or ochre to make body paint. And they figured out where, you can do a chemical analysis and you can figure out where it was mined. And then if you find that it was arrived somewhere 1,000 miles away, there must have been exchange, right? The cave, no? Okay, it could have been that they just killed someone, right? So I guess nobody knows. But anyway, some anthropologists argue that there was exchange. Maybe it was too pervasive. Of course, people did kill a lot of people in those days, too. Anthropologists report. So maybe Polanyi had it exactly right. But I think he had it at least approximately right, that exchange has become a bigger and bigger part of our lives, and that's modern civilization. So I'm going to talk mostly about financial exchange. That's the subject of this course. But I can be a little bit more general. I wanted to start by distinguishing a broker and a dealer. What's the difference? It's a fundamental thing. A broker, actually I've got this almost as a slogan. A broker acts on behalf of others as an agent to earn a commission. So it's for others, trades for others as an agent for a commission. The commission is a fee. What is a dealer? A dealer trades for himself or herself, acting as a principal, not an agent, and profits from a markup. Okay, so I can give you an example of each. When you buy or sell a house, do you get a real estate broker or a real estate dealer? Okay, that's almost obvious, right? Because you think you've heard the term real estate broker so many times. When you buy or sell a house, you commission a broker and you agree on a contract that pays the real estate broker a certain sum of money, maybe 6% of the value of the house, if a buyer is found. And then the broker doesn't buy your house, right? So the broker is an agent. And the 6% is the commission that the broker gets if he or she is successful in finding the other side of the deal. What's an example of a dealer? An antique dealer. Right, suppose you were buying a chest of drawers for your apartment. You go to an antique store, and there's someone there, your antique dealer, who has furniture that he now owns, having bought it, and then sells you and makes a profit by selling to you at a higher price, namely with a markup. He marks up the price that he paid for the item. So let me just ask you, why is it that way? Why are antiques sold by dealers and real estate by brokers? Well, I recently had a discussion with Guillermo Ordóñez, who's an assistant professor here, and we were wondering, maybe there are real estate dealers. Oliver helped us and found actually in Germany a couple of real estate dealers, but only like a couple. And we couldn't find any in the US. And we searched around in many other countries, and there was just virtually none. No real estate dealers. Anyone have any idea why? I'm asking you to think. It's a little. Or does anyone come from a country where they have real estate dealers, and that would end it if you, I bet not, right? Well, what about antique brokers? Okay, why not that? Have you ever heard of an antique broker? Maybe there are, you know, but it's an interesting question. It seems like some markets are naturally dealer markets and some are broker markets. We thought of one explanation why there aren't real estate dealers, at least in the United States. We learned that a dealer has to pay income tax on the profits from a deal, and that is at a higher rate than a capital gains tax, and so that closes people out. You wouldn't want to be a real estate dealer because you end up paying a higher tax. The other thing is, I wonder if there's something about information that someone who deals in real estate, it's just too hard to know what to pay for a house. Nobody, you know, it's so subjective. You can make big mistakes if you're going to buy houses and then resell them at a markup, because the market is just so variable, and you know, it ultimately changes quickly. Maybe, you know, it's too risky. I don't know. I'm trying to think. But of course, there are real estate dealers, just very rare. So we're going to talk about stock markets. And which do you think stock markets are? Are they dealer markets or broker markets? Well, the answer is both. And now it's not as clear. And I'll come back to this. The New York Stock Exchange. New York Stock Exchange in New York is a broker market, or they would say an auction market. It's a continuous double auction market where a broker facilitates the trades. The NASDAQ market is a dealer market. So you pay commissions to your broker at the New York Stock Exchange. You pay a markup to your dealer at NASDAQ. I'm just trying to think. I thought I will start by talking about stock exchanges and historically. And I have a lot to say. I can't cover it all. I was going to start with ancient Rome. I think I mentioned that before, but I'm getting there in my notes. The ancient Roman stock exchange is the first stock exchange that I think anyone knows about. But traders, I'm relying on the research of Ulrica Malmondier, who has studied the ancient Roman stock exchange as much as can be studied. There's not that much evidence about it, but the traders met outdoors on the Roman Forum at the Temple of Castor. That's where you went to buy and sell shares. The shares in Latin were called partes. I don't know if I covered this or not. And the companies were called publicani. The peculiar nature of the ancient Roman corporations is that they sold, their customers were the government. And so they did services for the government, like provide horses for the army, or they would feed the geese on the Roman Forum, on the Roman Capitol. They always fed the geese there because the geese were hallow in ancient Rome because they once warned of an invasion by cackling. So there was a publicanus that was in charge of feeding the geese. But that seemed to, and also they would talk about share prices. It's known that they would go up and down even then. But there's no data on their share prices. So it seemed that there was a long gap for stock exchanges after the fall of the Roman Empire, and the publicani disappeared. And there were there's a wide variety of financial arrangements, some of them resembling corporations. But the advent of the rebirth of the stock exchange really didn't occur until 1602 in Amsterdam, when I mentioned this before, when the Dutch East India Company started trading. And then Jonathan's Coffee House. I like that story. In London, lots of people would get together and talk there, and coffee houses became a big thing in the late 1600s. And somebody started posting stock prices on the wall at Jonathan's Coffee House by, what was the date? 1698. And so the London Stock Exchange grew out of Jonathan's Coffee House. And then moving forward in time, now we're going to get lots of countries, but I'll mention the New York Stock Exchange. The traders of shares in the United States met outside, and in 1792 under a buttonwood tree. I'll put buttonwood, that's a curious name. I think that's just a common tree that we still have around. And they signed the agreement to form the New York Stock Exchange. Then, what else? Next in my little history, India. By the 1850s, there were in Mumbai, or then called Bombay, there were traders under a famous banyan tree. They're all outdoors in Bombay. These banyan trees are more impressive than buttonwood trees. But it was by 1875, the Bombay Stock Exchange was founded. So that's the BSE. So that's been around for over 100 years. But things have happened more recently. And one thing that's been shaking things up, these are very venerable old institutions. What's been shaking things up is the advent of electronic trading. These were kind of old-fashioned, venerable institutions. Do you know what happens at the New York Stock Exchange? What happened then and still happens today? There's a floor called the trading floor. And the various brokers meet there, just like in Jonathan's Coffee House. They actually physically come to the floor and they stand around. And there are posts for each stock. And if today you think you have a customer who wants to buy IBM stock, then you go over to the IBM crowd. And there's a crowd of brokers there who are trading. And you just do it. Verbally, you talk to them and you make a trade. That's really old-fashioned. There is something more electronic and modern about the New York Stock Exchange, but that specialist post behavior still persists. Most of the world is switching over to electronic trading. And so things happen that, so for example, in India, they developed another stock exchange called the National Stock Exchange, and that was in 1992. And the National Stock Exchange was all electronic, and so it was the modern version. It's rapidly gaining on the Bombay Stock Exchange. So let me go a little bit more forward. China because of the communist government, did not have a stock exchange until 1990. And there were two stock exchanges founded in China in 1990, Shanghai and Shenzhen. And at least the Shanghai Stock Exchange is owned by the Chinese government. And that's why Laura Cha, when she talked to us about that, she was on the China Securities Regulatory Commission, which actually owned the Shanghai Stock Exchange. So that's the, Latin America. Sao Paulo, Stock Exchange, 1890. Mexico has only one stock exchange, but it was founded in 1894. So we seem to have like two different kinds of exchange. We have the old exchanges that are at least 100 years old, and we have the new electronic exchanges. Things have really sped up with the advent of electronic exchanges. So I mentioned the New York Stock Exchange, which was started on the street, outdoors, and is an old-fashioned exchange that has been slow to update. But more recently, we have, I mentioned it already, NASDAQ. It stands for, originally, National Association of Securities Dealers Automatic Quotation System, which was created in the 1970s. The interesting story about NASDAQ, in the 70s, the New York Stock Exchange was highly prestigious. It was the big board, the place. And a critical element of a stock exchange is that in order to get your stocks traded on the exchange, you have to satisfy listing requirements. So the New York Stock Exchange would examine any corporation that wanted to be listed on the exchange, and it was the prestigious big exchange. So it had high standards. So the company had to have a history of earnings. It had to have the right kind of management structure and board. A lot of things were checked out by the exchange. And as a result, the way it would work in the 1970s, a startup company could never get traded on the New York Stock Exchange. It would be traded instead by brokers off exchange or over the counter. So OTC means over the counter. That means not on an exchange. So in the 1970s and earlier, the over-the-counter brokers would deal with each other informally with telephone calls, or actually out on the street. They'd meet each other out on the sidewalk originally, and then they got telephones. And they had some record, which they called pink sheets, because they were traditionally printed on pink paper. These were lists of dealers buy and sell quotes on prices of over-the-counter stocks. The National Association of Securities Dealers then was an organization of these over-the-counter traders, and in the early 70s, they set up the first computerized system. They decided that everyone's telephoning everybody. Let's create a system that that really works and that gets us the information. And so that was the NASDAQ system, the first computer-based system, which has now increasingly taken over much of the world. I shouldn't imply that New York Stock Exchange was entirely a laggard on this. Electronics played a role in stocks going back very early. The New York Stock Exchange used telegraph in the 19th century to convey prices, and they invented ticker tape machines. A ticker tape machine is an electronic printer that would print out stock prices. And in fact, Thomas Edison, the inventor, his first invention was actually a ticker tape machine. That was in, I think, the 1870s that printed stock prices. But all it was a record of what had traded recently. It wasn't a system that helped you trade. It just reported what had happened. It was historical. So I wanted to show you what NASDAQ created in the 70s. And it's a order book that would be visible to everyone who trades on it. Prior to discussing that, I want to tell you about different kinds of orders. If you buy and sell stock and you call up a broker and you say, I want to buy and sell, the simplest kind of order is a market order. And you would specify the quantity. You would say, I want to buy, and the name of the company, of course. I want to buy 100 shares of General Motors, or I want to sell 100 shares. But you don't name a price. You'll find out whatever the price was. The broker will get you the best price. Will try, if he or she is a good broker, will try to get you the best price. But it'll still be unknown to you because you didn't specify it. You might be unhappy with the price. The price might be too high, okay? And then the broker will say to you, well, you know, if you're unhappy, you should have told me. You could have told me not to pay more than a certain amount for a buy, or not to take less than a certain amount for a sell. So the alternative is a limit order. And so with a limit order, you give both quantity and price. So if it's a buy, I want to buy so many shares, but I don't want to pay more than such and such a price. Then the broker will keep that on his or her books until, well, whatever the agreement between you and the broker is. It might expire after the day is over, or you could ask to have it kept on the book. And when the price becomes available, which is no higher than your specified price, then the order will be executed. Otherwise, it won't be executed. And then for a sell order, it would be the same thing. You know, you specify both a quantity and a price, and the order will be filled or partly filled. You might not be able to get all of your quantity, but they'll fill as much as they can of it at that price or lower. And there's another kind of order called a stop order. With a stop order, you also specify quantity and price, but it's different. With a limit order, you would buy. Say it's a buy limit order. Well, let's talk about sell. If it's a sell limit order, you would sell the quantity at such and such a price or higher. With a stop order, you would sell that quantity at such and such a price or lower. Let's make it clear. A stop order, also called a stop loss order, is an order that you can place with the broker to indicate that I'm worried that this stock might really collapse, and I'm holding it, but I want you to sell it if the price starts falling a lot. So suppose the price is 100 today, I could put a stop loss order at 80, and then at least I know I can't lose more than 20% of my investment, because the broker will immediately sell it when the price of that stock falls below 80. There's also a buy stop order, and that would be something that someone would rationally do if that person had shorted a stock. So if you had shorted a stock and you were worried that the price would go up and ruin you, you can leave with your broker a buy stop order to sell it, to buy the stock whenever the price exceeds a certain amount. And you would do that to prevent yourself from having unlimited losses on your short position. So there's other kinds of orders, but those are the main kinds of orders. So now I wanted to talk particularly about limit orders. That's the most important kind. A lot of advisors say never place a market order. Why should you ever do a market order? There's always some price that you'd be unhappy with. You might as well say that. And so some exchanges don't even allow market orders. So let's talk about limit orders. And what I wanted to show you was what a NASDAQ level 2 customer sees. NASDAQ is an organization. Now it's a firm traded on its own stock exchange, or it's called NASDAQ OMX. But if you want to subscribe to NASDAQ, it's very expensive, I understand. So you can subscribe at level 1 or level 2, which is more expensive. And I was going to show you an example of what you would see on your computer screen if you subscribe to NASDAQ level 2 for a particular stock. And so this is a hypothetical limit order book for Microsoft. What it shows, this is not live, but it would be live on your screen. And these numbers would be changing before your eyes, flashing back and forth before your eyes. And so I've just frozen it at a moment in time. So what do we have? We have 6 columns here. This first column is the shares that people want to buy. So the first 3 columns correspond to those. So the bid is the price they're bidding to buy these shares. Okay. Remember, NASDAQ is a dealer market. So these dealers are making these bids, or people are making them through a dealer. And MPID is the marketplace ID, where these bids and offers are being made. So the first one shown, someone is offering to buy $100 shares of Microsoft at a price of $25.23, and that is listed on ARCA-X. ARCA-X, there's an interesting, so I didn't mention that exchange. It's now part of the New York Stock Exchange. Maybe I'll come back to that in a minute, but let me just continue to explain this slide. Now, you note that the bid prices are arranged in declining order, right? They go down as you move down. The computer has sorted all the orders. These are all the unfilled orders. Someone called their broker and said, I want to buy 100 shares, and the broker entered the bid through ARCA-X, and it's now on the NASDAQ screen. Someone else had a much bigger buy order, wants to buy 9,430 shares, and this came in directly to NASDAQ, but it's a penny less, $25.22. And so you can just see what's going down. Now, the other side of this, is that clear what we're seeing here? The other side of the screen is the buy orders, and it's exactly the same, except that here the numbers go up as you move down the screen, because the computer has sorted them in the reverse order. So that represents what various people are willing to buy. So somebody is willing to buy 2,400 shares at $25.24. Okay, and somebody. Well, actually, there's 2 different customers. This one placed the order first, so I think that's the priority. It's by the one who placed it first. Somebody else at the Cincinnati exchange, I guess that's what that means, offered to buy 8,200 shares at the very same price. but it's listed as a separate order, and so on. So now you're sitting here looking at the screen now, and you notice that this ask price here is higher than the bid price there. So what does that mean to you? It means there's no trade, right? Because someone is offering to sell at $25.24, and somebody's offering to buy at $25.23. It's no trade until somebody changes their price. Now, that's no surprise because these orders would be filled very quickly if there's a crossing. See, these two lines don't cross. So it's like if you plotted these curves. There's supply and demand curves, right? We could plot the amount at various prices. Well, you can see I'd have curves that are supply and demand curves that don't cross. Normally they have to cross somewhere, and then there's a market clearing price. These things normally don't cross because if they did cross, it would immediately disappear from the screen. Someone would finish the order and they'd sell. But you sitting at the screen now have a pretty good idea what the price is. A NASDAQ level 2 is better than NASDAQ level 1 because level 1 just gives you the first row. All right, it's cheaper to subscribe to that. What NASDAQ level 1 gives you is the inside spread. It would tell you that there is 100 shares bid at $25.23 and asked at $25.24. And if you want to hit that order, you could take either side of that. But it doesn't tell you the whole picture. If you know NASDAQ level 2, you know a lot more about the market. And if you're going to play the game of trading, you want to know this. So for example, you know that it might be hard for a price to fall rapidly below $25.22 because there's a big buyer down there. And so it's going to be hard for the price to fall below that. If you saw the screen in real life, these numbers would be just blinking, changing rapidly before you. And trades that were there 20 seconds ago would be gone in a flash. So you've got to move fast to execute these trades. On a fully automated system, the trades would be executed automatically. And this is becoming, electronic trading is taking over the world. And the orders can be executed by computers that make it instant so that the number doesn't even appear on the screen long enough for you to see it. So one development that's coming in now is what's called high-frequency trading. HFT, which is trading that is done by computers. Once you have a system like that, when you have to trade through a floor broker on the New York Stock Exchange, it has to proceed at human pace, right? The way it works is you make a telephone call to your broker makes another telephone call to the representative on the floor of the New York Stock Exchange. That person walks over to the crowd and then discusses it. It indicates it's like a poker game. You don't want to reveal your hand, but you kind of feel people out, and then after a little discussion, you reach a trade. But when you have something that you can hit on a computer, it just goes instantly. So people start programming trading, and that's been an important phenomenon because you see these things moving faster than you can. These prices disappear and reappear so fast that you can't quite know. You can't act fast enough. So we have algorithmic trading or program trading. And so that goes back to practically to the 1970s. Certainly by the 80s, program trading was becoming a big and important phenomenon, and it's becoming increasingly important now. High-frequency trading now, brokers will invoke what are called millisecond strategies. You can actually flash an order on some of the exchanges that lasts a thousandth of a second. You can put a buy order or a sell order and retract it in a millisecond. And that means this would be a trading strategy which you might employ. You could do that to discourage people from trading. If you want to trade only with the computers, if you think, people are too smart for me, I don't want to trade with people, I want to rip off the computers, then you write a millisecond trading strategy, and then you can sort into who trades with you. Now the interesting thing about millisecond trading is that it's favoring the electronic exchanges. More and more, as time goes on, people are getting more and more sophisticated about high-frequency trading. And so they want to trade on exchanges that are fully electronic so that they can play all of these games. And that means that the floor exchanges are dying out over most of the world. By the way, the New York Stock Exchange, I was going to give you a history of this. The New York Stock Exchange has been slow to adapt to these technologies. Let me just give you a little history of electronic trading. Is an exciting thing for many people. But I think it started, or the really interesting electronic trading started with the ECNs, electronic communication networks, that were allowed by the Securities and Exchange Commission as alternatives to stock exchanges. Stock exchanges are highly regulated by governments around the world. But in the 1990s, the Securities and Exchange Commission allowed more sophisticated electronic trading, at least as an experiment. So they didn't call these things exchanges, they called them ECNs. And one of the most important ECNs was a company called Archipelago. Another one was called Island. And these were actually just websites where you could trade, and they were open to the public. They had a different culture. They had more of a web culture. The web culture is, we're not going to charge you to see the order book. We'll just put it out to everybody. Right? The web doesn't charge you for a lot of things. And so they became popular trading sites for the general public. They grew up the way the personal computer grew. So New York Stock Exchange, when they first saw Archipelago, they said, oh, this is a bunch of college kids fooling around, some computer game sort of, and they didn't take it seriously. But eventually, New York Stock Exchange had to take it seriously because Archipelago was growing so fast. So eventually, New York Stock Exchange merged with Archipelago. And so they're now, I think most of their trades go through ArchaX. I'm not sure if that's right, but a large fraction of their trades go through ArchaX. So yeah, New York Stock Exchange bought Archipelago in 2005. At that time, ArchaX was breathing close on New York Stock Exchange for trading volume. Things are happening fast in the stock exchange because the technology is changing. Whereas we had the New York Stock Exchange in the old days, it was this single prestigious exchange that lasted for over 150 years without any substantive change. But now electronic trading is coming in, and everything is being shaken up. So the New York Stock Exchange merged with Archipelago in 2005. And then they did another merger, let's say the New York Stock Exchange, with Euronext, which is another exchange in Europe, in 2006. And right now they're going through another merger process, apparently with the Deutsche Börse, and that's 2011. It's not finalized yet, and now NASDAQ is getting in. NASDAQ is making an offer for the New York Stock Exchange, and so is another exchange called the Intercontinental Exchange. But the little guys are buying up the old-time big guys, so it's... Laura Cha was saying in her lecture that she was struck that we used to think of stock exchanges as like utilities. Each country has its own stock exchange. It's the pride of each country. But now it's not happening anymore, and this reflects a bigger and broader trend that economies are becoming more and more integrated across the world. So the idea that there will be a stock exchange for each country is becoming dated. So the New York Stock Exchange may soon be a German company, but that's what happens in modern times. Now I wanted to talk about some problems with high-frequency trading as things get so electronic. Let me give you one example. In 1987, this was the early days of electronic trading, but still it had advanced pretty far. On October 19th of 1987, the stock markets in the United States fell, according to the S&P 500, over 20% in one day. The government did a study. President Reagan ordered a study and put it in charge of Nicholas Brady. And so the so-called Brady Commission did a report on why the stock market, that was the biggest single stock market drop in U.S. history. And the Brady Commission did a report on that stock market drop and concluded that program trading, computer trading, had played a big role in the drop. There had been a development of programs that were called portfolio insurance sell strategies. They called it portfolio insurance, but it wasn't really insurance. It was a automatic sell strategy. It's like a stop-loss order, but a more sophisticated one that could be executed in continuous time by a program. And that led to an instability in the market that was not anticipated and shocked the world. So the Brady Commission made a number of recommendations. Notably, the Commission recommended that the exchanges impose trading halts that would prevent stocks from dropping, the whole market from crashing. So the New York Stock Exchange and other exchanges, after the Brady Commission report, instituted what are called circuit breakers. And these are automatic market halts that stop the market when prices are falling to help prevent another 1987 type stock market crash. Now, but the system is getting complicated. Even before this, the United States government had passed a set of rules in response to complaints about people not being given the best price. So here's the problem. We have multiple exchanges. The New York Stock Exchange is one of many. And if you call a stockbroker, the stockbroker has discretion over which exchange the broker will use to fill your order. And so the broker might choose an exchange that doesn't give you the best price. The broker can, in effect, rip you off as a broker. In fact, there's a practice called payment for order flow. So a stockbroker who is receiving orders from retail clients may find that there is a dealer that's willing to pay for order flow. When a customer asks to buy the stock, don't put it through the New York Stock Exchange. Give it to me, and I'll give you, the broker, a fee for directing the order my way. And that may not serve the client well, because the client then might end up paying a higher price. So there were a lot of complaints about this, and it's a difficult problem because it's hard to monitor everything that people do, and there might be justifications for payment for order flow. But there have been efforts to try to make it a fairer system. And in 1975, the U.S. Congress set up something called the National Market System. NMS is the National Market System, and the ITS is the Intermarket Trading System. What the government in the United States did is it said that brokers have to get the best price, what's called best bid, best offer, best bid for their clients. And they have a responsibility for their clients to take the market with the best price. In conjunction with this, the exchanges built something called the Consolidated Quotation System that allows brokers to see prices on various exchanges and direct the order of the client to the exchange that's showing the best price. So that is a system that was started in the United States in 1975, and brokers still have an obligation to get the best price for their customers, regardless of exchange. But the obligation is hard for the government to monitor, and it gets complicated. For example, if you're confronting this system and your broker wants 500 shares, well, I can't fill them all at the same price, right? Well, actually, I could here. If the broker wanted 10,000 shares, it'd be all different prices, because I have all these different customers, right, asking different amounts. So, what do you want us to do, SEC? And so the SEC recently clarified this, I think it was in 2006. Well, we only mean that you have to hit this, the best one. There's one up here, 2,400 for 25, 24. How you fill the others, we can't get into that. So it's not a complete protection for customers, but there still is this obligation for brokers to use the National Market System to get the best price. But the system is complicated and confusing because there's so many computers involved, there's so many different exchanges, there's so many rules. It's hard for people to keep up with it. So I had on the reading list, I had a report that I found the report. It was very much in the news a while back. This is a report on May 6, 2010. You remember what happened then? That was not that long ago. The stock market, as of around 2:30 in the afternoon in the United States, had fallen 4%. And then within a matter of minutes, it dropped another 6%. And then it rebounded quickly. Some individual stocks dropped practically to nothing. And you could buy a $30 stock for 30 cents or something like that. And then they rebounded. So what happened? Why did we have this very brief crash in the stock markets? It wasn't like 1987 where the market went down and stayed down. If you look at closing prices, nothing much happened. It was this brief glitch, which probably cost some people huge amounts of money, because if you were trading right at that moment, you'd have a problem. So I have as an optional reading on the reading list a study that was made of May 6, 2010 by the SEC and the Commodity Futures Trading Commission, trying to understand what happened then. And the study does focus on high-frequency trading. There were a lot of computers trading automatically at that moment in time. So what apparently happened on May 6th is the market was already in a stressed mode before 2:30 p.m. The VIX index had shot up. There was some bad news. The market was down 4%. There was some bad news. So that meant that some traders were wondering what's going on, and maybe they decided to drop out for a while and just be cautious. And so the computers were still trading. And then something happened. The computers started trading back and forth in milliseconds. And I don't know what the programs were supposed to do, or what they, maybe nobody knows the whole picture. But the volume of trade just went to an astronomical level, and it scared people off. And so there were a lot of trading pauses that were put. Exchanges have rules about that, and individual dealers will say, I'm dropping out. I see all this volume, I'm not in here anymore. So it remains that the trading that was left was substantially computer trading, and the market became very illiquid. And so this study has recommended fixes for this. But it doesn't recommend ending high-frequency trading. And a lot of people would recommend doing that. There's a popular anger, especially since this May 6, 2010 crisis occurred during the period of financial crisis, and people kind of imagine that the two are linked. I think they're kind of independent. I think the May 6, 2010 phenomenon was due to some kind of anomalies or infamiliarity with high-frequency trading. It's a glitch and not a major fault. But it led to a lot of anger about high-frequency trading. But I've talked to some people at the Chicago Mercantile Exchange and others who think that the public anxiety over high-frequency trading is misplaced. It's kind of inevitable. The future is computers, right? They're replacing people all over. Not in a judgment thing. You know, someone was saying at the CME meeting where I was that the basic business that we're doing is still the same as it was 100 years ago. But now we have laptops, right? It's just like when you write a term paper. It's basically the same thing that somebody would have done with a feather pen and a piece of paper 200 years ago, right? It's basically the same. But we live in a computer age now, and we don't want to go back. And so high-frequency trading means that we have to be a little careful. Things can happen with lightning speed, but we'll learn. And you know, there hasn't been another May 6, 2010 since. It was just an anomaly because people were unfamiliar with that kind of event. And so I think it will be all right. And one thing that it does, however, is it's changing the geography. It used to be that in the 18th century, a stockbroker had to live in London or Paris or New York in order to be close to the trading, right? Because they didn't have any way to make phone calls. When they invented the telephone, people said, fine, I don't have to live in New York anymore. I can live in anywhere, and I can just send my call by telephone. But now high-frequency trading is bringing it back, that people have to live close to the exchange, because the trading goes so fast that your electronic signal, if you try to set up a high-frequency trading operation in St. Louis, and you're operating by wire to New York, the time it takes for electricity to get from St. Louis to New York is too big, and you will be behind on the trade. So you want to get as close as physically possible to the exchange, to the computer. You don't see the regional exchanges. There used to be exchanges in every big U.S. city, and they were there because of social reasons. That people in Chicago wanted to talk to a broker in Chicago. They wanted to be able to go to his office and see him. So there were social reasons for a connection. But now we're coming up with a new electronic reason, and because of basic theoretical physics, you can't move anything faster than the speed of light. This is going to be with us now that we have microsecond trading. I wanted to talk a little bit now, and I think maybe this will be the last topic, about how you think about trading as a dealer who's confronted with this kind of book. As a dealer, you can put orders on this book and enter them and leave them there. That's basically what you do. So you see various dealers, and their names are shown. For example, well, I don't know who these people are, but each dealer is going to be posting a bid and an ask, right? And a quantity for these. And it's going to be, if you do this, you're sitting at your NASDAQ screen, and you're a dealer. You can enter your own number on either of these, either the bid or the ask, or both of them. So you have your own bid-ask spread, okay? It's the same thing as an antique dealer, okay? An antique dealer has an idea, maybe it's not posted, of how much he or she will pay for a chest of drawers from a Yale student at the end of the semester, and how much he will charge to sell that. And the difference between the ask and the bid is called the spread, or the bid-ask spread. And so I want to just think a little bit about the theory of this, and how do you decide of the bid-ask spread, of what to do? And why is it what it is? The spreads are obviously very tight here, because they're off only by 1 cent on the inside spread. But it doesn't correspond to one person. Maybe some of these are customer orders and aren't dealers. But think of placing an order as a dealer and leaving it on the screen so that anybody can come and the risk that you face is that you will be picked off by people with superior information. And let me put it in the context of a antique dealer. One thing that antique dealers don't like is when professional antique dealers come shopping in their store, all right? So what do? You know, if you're a good antique dealer, you go to all the antique stores, you try to disguise yourself because they don't want you if you're a dealer. What do? You look through all their stuff and you find anything that's mispriced. You know, there'll be some chest of drawers that you recognize as a 18th century, you know, by a famous furniture maker. So you buy that at the guy's price. You pick him off, right? So he doesn't want to be picked off because somebody will come by who knows more, will pick off all the good stuff and buy it and leave you with the junk. So how do you prevent that? Well, you might think that you could prevent it by just being smarter, but you can try. Try to be as smart as you want and read up about all the antiques, but it's impossible. You cannot be the smartest guy out there. Impossible. There's just too many antiques and there's too much inside information. So that means you have to set your bid-ask spread wide enough that you can be picked off and still make a profit. All right, you know you're going to get picked off. And it's the same for stocks. If you're going to put a bid-ask spread up on the screen for some stock, you're just a sitting duck because there'll be some news story that's either good or bad. And if it's either way, somebody else is going to hear of it first. And when you get a hit on your order, it's going to be deadly because it'll be at the wrong time for you. So that's the theory, that you have to make the order, the bid-ask spread wide enough. Now, I wanted to then just give you a little bit of I shouldn't end a lecture on mathematics, but that's what I'm doing here this time. And I wanted to just talk about the frustrating life as a dealer. I was telling you about frustrations in life as an investment banker. There are different frustrations in life as a dealer. And I'll tell you what the difference is. Life as a dealer is very different than life as an employee or something. You are a dealer, and you have whatever money you make. And the problem is you can get ruined. And this is a classic. In other words, you can be working as a dealer for 20 years, and you see your portfolio growing because you're making a lot of money selling. But you know, all it takes is a few bad moves, and you can be wiped out. You know, 20 years of work, and you are ruined. So I want to just think about that. And this is my last bit of mathematics. There's a mathematics of gamblers' ruin, and it's also a mathematics of dealers' ruin. And so here's the theory. If I start out with S dollars, S is my initial amount of money as a dealer, okay? And let's say I take a series of bets which have a probability, P is the probability of a win, okay? What is the probability of eventual ruin? Oh, and if I make $1 on each win, and I lose $1 on each, minus 1 on each loss, I'm doing a sequence of bets on each loss. All right. What is the probability that I will eventually be ruined? Okay. That probability, and I'm not going to derive this, but it's simple to derive actually. 1 minus P over P to the S power. If P is greater than a half. If my probability of winning is a half, the probability of my being ruined eventually is 1. If my probability of winning is less than a half, my probability of being ruined eventually is also 1. I have to somehow raise the probability of winning on each particular sale above a half. But even if I do that, if I make it, say, 0.6, if I make the probability 60% on one bet, then 1 minus 0.6 is 0.4 over 0.6. Then my probability of eventual ruin with starting out with $1 is 4.6, if I did that right, goes down with the number of dollars I start, but it never goes to 0. So the theory of a dealer is that a dealer has to be thinking about being ripped off. I've got to set my bid-ask spread high enough that the probability of winning on each of these little trades that I make is sufficiently above a half that my eventual ruin probability is satisfactorily low for me. But it's never going to be 0. This is the irony of being a dealer. You don't sleep well at night because you never know that it won't eventually unwind. And it's a competitive business because you can't just set your bid-ask spread arbitrarily high because then you'll lose all the business to other people. So you've got to kind of fix the bid-ask spread enough that you get business, but you don't want to fix it too narrowly so that this probability falls too close to a half, because then you're courting the risk of disaster and eventually having all of your life's work being wiped out. So that was kind of a quick description of the, I'm saying different personalities go into different parts of finance. You have to be kind of a game player, someone who is not bothered by the possibility of eventual ruin in order to go into to becoming a dealer. It's very different from other aspects of financial life. All right, I'll see you soon with, we're getting close to the end of the semester. Some wrap-up lectures coming.